They call it the right stuff. Get up and go. Fire in the belly. We call it ambition. The drive that starts with an itch. An idea. It turns a dream into a plan. Takes aim at success and never looks back. So if you want to get there, you can start right here. CNBC. Live ambitiously.
Keep up with the crisis. Understand what's moving and why. Be ready before the opening bell. Squawk on the Street on CNBC.
Anita Mukesh Ambani, the founder of Reliance Foundation, speaks about her new cultural center.
It's taken us now a decade to bring this to life, to show the best of India to the world and get the best of the world to India.
On the Reliance Foundation,
a nation's development depends on women empowerment and the well-being of its children.
On family,
I am so blessed to have Mukesh, who is my best friend and my life partner.
Anita Mukesh Ambani sits down for the CNBC conversation.
Commit to energy. Focus on innovation. Discover the next growth opportunities. Climate technology. All you need to know to invest in the future. The ultimate source. CNBC.com/climate.
Futures are mixed this morning as we wrap up these last few trading sessions of October, Jim. And as we look toward the end of the year, Goldman's got a note out today. 47 trading days left in the year. The desk does think that the setup is cleaner in November, and they argue that a year-end rally hasn't been canceled, but maybe delayed a touch.
Well, look, I think throughout this period, whether it be the Mideast or whether it be the budget deficit, we forget what the Fed wanted to do. I mean, it used to be all you talk about was that can they get the price of housing down? Well, cancellations for housing have spiked. Can they get the cost of automobiles down? Well, used cars have come down dramatically. I now want to know, where are they losing? They are now winning on almost every single inflation front, except for we have not seen rents go down because housing's so expensive, people are staying. But I think they're winning. And I think that we have to recognize that if we had these numbers 2 months ago, we would say, you know what, we're going to have some cutting next year.
Well, a big part of the constructive thesis last night was that the PMIs, we look pretty good.
Well, the industrial part of the country is, I mean, look, I was on the phone with Judy Marks from Otis. The profit margins are incredible. We have PACCAR, we saw a positive beat. Industrial is just flying. I don't know a weak industrial. But then I look at the freight numbers, say from Norfolk Southern. I like Norfolk Southern very much. I don't see much to like. Union Pacific, I don't see much to like. I come back though, if you're worried about the working person, you should be less worried about inflation than you are.
Yeah. Roper today, upping guidance.
Right, and that's what I keep getting. I've got these industrials that just don't know how to stop cutting, and look at Boeing. I mean, Boeing is up in part because they really know how to run an airplane.
Let's get the opening bell here and see how Brett fills in at the big board. It's Vestas, provider of uniforms and workplace supplies, celebrating its recent spinoff from Aramark. At the NASDAQ, it's Spectair, an industrial technology company, celebrating its recent listing via SPAC.
Just say, Carl, that Cintas, which is the nation's largest uniform company, I have them on. It's one of the greatest stocks of the era because it's so strong. People keep wanting more uniforms. It's safety. So I want to watch this. I want to watch this spin-off, not just because we're from Philly, but because this has been a tremendous business.
You know,
What do you hear no evil? What is the other? There's no evil here.
I think we need more cowbell.
Look at this. Apple says that I'm in a loud environment. I have to go.
I was just thinking, Mark Haynes probably would have brought in those ear, they wear them on the ramp at the airport, that kind of thing. We probably would have done that at some point.
We might need to do that, actually. Maybe we can get, like on an NFL broadcast or something like that.
Okay, I'll work on that.
All right, let's do that. I think it'll be a good look.
It's funny because I was focusing on Alphabet versus Microsoft, but I see your priorities.
There we go again.
David, can we talk about, I wanted to bring up Alphabet just because
let's talk.
The advertising side says to me, you wouldn't share take? I wish they didn't even have a cloud because the advertising share take, David, I honestly think
advertising on Alphabet was quite good, and there are those who want to read through on Alphabet to Meta potentially being positive. Obviously, Meta the largest out there in terms of advertising. To Jim's point, YouTube, $8 billion in ad revs during the quarter. This gives you a sense into the size of that unit of Alphabet. Remember, they do have a Sunday ticket now. That's helpful. Here's a look at Meta, not benefiting from those ad numbers at Alphabet. Perhaps, guys, in part because of some comments on the Snap call. As you see, Alphabet shares down over 8%. Snap during its call, and by the way, looked like a pretty good number from Snap. But they said that since the onset of the war, they have had a number of primarily brand-oriented campaigns pause spending in the early period after the onset of that war. And they've seen a number of the campaigns resume spending, and they don't see a huge impact to their daily run rate, but the impact to our daily run rate has reduced significantly as a result of that. So that may be pressuring Meta a little bit because of worries about the guidance that we're going to get from Meta, despite what were very strong ad numbers from Alphabet.
Well, I would tell you that as someone who has, other business life does Reels and Instagram, that you kind of that money's autopilot. You just spend it because it's the lifeblood of your business. So I'm not sure about the impact on Meta. I think Meta is a very good company. The one that I'm surprised to read through Amazon Web Services, Amazon's doing quite well, advertising well, and I think people have just said, you know what, maybe I'm done with the mega caps. I mean, Microsoft was, as David mentioned earlier, the numbers are so big that when you read other companies, you just think, wow, Lilliputian. The numbers are amazing.
Yeah, I mean, B of A said, tough night to miss on cloud, given that you were printing right alongside Microsoft.
Yeah.
We haven't seen a lot of downgrades of Alphabet, but Monest does say the tone of the call, Jim, was riddled with evasive commentary. Back in July, they announced a search for a new CFO. We believe it would be wise to bring in an executive who speaks the language of Wall Street.
Oh, man.
And they do cut to
They're talking about Ruth Porat.
I want to get to that because on the call itself, there was a key question from Brian Nowak about cost, about expenses. And the response from Ruth Porat, who is president but is still CFO as of now, it unsettled a couple of investors. I think later they may have called around and said, but take a listen. This is the question she was asked. You spoke about durably re-engineering the cost base. I think in the past you talked about how expenses could grow slower than revenue in 2024. Is that sort of still the high-level way to think about it, or is that potentially changing as investments continue? Remember, we're talking about a company spending as much as $40 billion on CapEx. This was the answer from Porat to that question. Take a listen.
Overall, that's sort of a truism, as you know well, that looking to grow revenues at a faster rate than expenses as we're focused on delivering sustainable financial value. And so that really takes us to the work streams, which I tried to tick through again. Those remain the driver. They're the real priority. Those are the efforts that are going to enable us to keep expense growth as moderated as possible while supporting the investment growth that is so exciting in front of us, in particular around AI.
All right. You know, Ruth Porat, a great executive, many would say. That was not one of her great moments there.
No.
That was not a great answer, and that unsettled some people because it wasn't clear.
No, it wasn't.
People want to hear you're going to revenue growth is going to outpace expense growth. That's what they want to hear, and they didn't hear that.
Well, and then you're on the Microsoft call, and David, they have the head count there is down, the spend is down, and Amy Hood, who had been the person who took the stock down last time, because she was talking about maybe having too much spend. David, they're cutting, and what do we always want? We want companies that are cutting expenses and growing revenues. This was a textbook call. I would be studying this. I would be studying this as a case study.
Microsoft,
and how to be able to cut back and also have revenues ramp. It was, by comparison, I felt bad for report. I wish they reported another day. Because you're up against the king.
And Copilot, by the way, seems to already be used.
I gotta get it.
$350 a year. What did they say? About a million subs so far. It could be enormous.
It could be enormous.
I mean, $350, and you could potentially replace somebody.
Well, but remember, it makes you more productive. November 1, we can all get it.
Right. So does it mean that you can replace out of a certain percentage of the workforce because of the productivity enhancement from Copilot? I don't know.
I don't know, but I think I can hire. You're going to save me all that money, and you're a progressive.
For example, here's something you can do.
Okay.
You have a Teams meeting. Right? You meet on Teams. It will summarize the whole meeting for you.
You're not using that?
No.
David, have you ever put in?
I was just do a quick summary.
Please give me the 10 most important points in the Microsoft conference.
Right, but this is your actual own Teams meeting.
No, I'm just saying that this thing is, Carl. This thing is real, and I got to get this Copilot just to be able to get up. Every 25-year-old is going to be better than we are, and I'm not going to allow that to happen.
So they lose their job 5 years after that because they're not needed anymore.
Well, you think we're worth a lot? I mean, don't you think that we're
history? But we're at the end of our careers. Well, you and I are. He's a young man still.
Well, that's true. I mean, but I do think that I was filled with positives about AI last night, not negatives. And by the way, the companies that they have, I come away from that conference call and I just said, I remember when I first brought Microsoft into Goldman Sachs as a IPO, my friend Steve Ballmer, who was with me at school, and I remember thinking, these guys, they could be $1 billion company.
Well,
you were right.
It's a new leg of growth under Nadella. That you can't say enough about the leadership he's shown here, their ability to execute at this point. I don't know if we had that since Nadella took over kind of chart, but my guess is it would show something quite significant in terms of the appreciation of the stock.
Yeah, he's truly one of the most competitive velvet glove.
Yes.
The guy's a velvet glove. I mean, there's just no doubt about it.
What about read-through from these quarters for Amazon? You mentioned it briefly.
I'm positive.
There is a belief that Amazon's going to guide toward operating leverage, which is what everybody in Amazon wants.
Well,
you think that'll happen?
I think that Andy Jassy has closed a huge number of programs that Ruth Porat has not closed. These tangential programs. Look, I like Jassy, and I think that Jassy wants to win. Unlike the team that he supports, the Giants, which don't seem to be as inclined to win. And I just think that he is not going to let up. He's going to listen 10 times to that Microsoft call, and he's going to say, we got more in our game. And that's what's going to happen. He's not going to lose. If he loses, by the way, I'm going to just pants
And then, again, Meta coming very soon, earnings-wise. What about there? OPEX, like a lot of the bulls want OPEX at $100 billion or less. Could it be more than $100 billion? CapEx, $40 billion. Will they ramp up again in Meta spending? On the metaverse?
If it's a year, you're talking about a year of living dangerously. He's talking about a year of efficiency. Linda Hunt.
Meta's still a 17 multiple. Like, would they, maybe they get a 20 if they actually come in with a...
Look, I just think that maybe we're at the twilight, get this, I'm going to say it, of TikTok, because when we do ads, Reels is better. finally happened.
Were you unnerved by the dozens of states that filed that action yesterday against Meta about impact on kids?
I thought about that. Obviously, I'm not going to dismiss when every state gangs up on a company, but it used to be if you take away their TikTok, people will be angry. You take away the Reels, that's not the way you're going to win at the ballot box. It's that powerful. I mean, look, I think you have to do ads to know who's good. I have the fortunate ability to do ads, and if you want to reach people, you can do it through Google. I'd rather do it through Instagram and Reels. It's just a better experience.
Jim Texan, this is a 3-year low.
Well, look, if you're in the conference call, okay, I'm going to get my blood was boiling in that conference call. Those guys, they work for the shareholders. They have total contempt for all the analysts. And when I listen, they ought to develop a little more humility because their industrial business is awful. The comms business is awful. Only auto is good. I know they spend a lot of money. I know we revere them for who they were. For who they were is probably the way I can say it.
Inventories went the wrong direction.
It was such a
guide below. Recovery's not quite here yet. Revenue shy.
That was the worst conference call for tech I've heard yet.
Texan, yeah.
Yeah, by far actually. And then you got this conference call that was really interesting from ASML Holdings. Well, the Dutch. This is a company that a lot of people feel is at the fulcrum of making China a force or not. And they had really good orders from China, which I think is interesting because you're not supposed to have good orders from China if you're at this particular moment. Now, the stock was down. The stock was up 20 earlier today. But there are people ordering semiconductor capital equipment, and Texan is spending $5 billion. It's just that I just felt for them because, my God, they were asked repeatedly about why things aren't better, and they're just saying because they're not better. I mean, it's kind of like a Ruth Porat. Look, both Ruth Porat and they were very unsatisfied. How's the? Did you get? How's the multi-screen there for football? People like it.
They do.
People like it.
They like
when you go to Eddie Q, he says MLS. Stay tuned, as he said to us. And then Messi comes. I mean, there's a guy who delivers the goods.
True. And does it while he's wearing pink. Very nice.
That's Mike Sievert.
Yes, he also wears pink. Jim, I wanted to hit something we've talked about in the past, always almost positively, which is Thermo Fisher.
Oh,
because
Mark Casper.
Until about a couple of years ago, this was one of the greatest performing stocks over a long period of time. We hit Danaher the other day. We mentioned how it sort of hit a wall.
Let's bring Danaher down again today.
Look what happened here, Jim, and look what's been happening of late.
Okay, and Danaher's awful. I mean, what's happening?
Let me point out, they have cut their outlook, and that is obviously why the stock is down. Revised outlooks. A lot of this medtech stuff is...
You need IPOs. This is the IPO
Danaher's down again, by the way, as well.
Look, we bought some Danaher yesterday. I got clearly wrong to buy it that quickly. We bought very small. The reason we did, though, and have bought this because it's a great company, is that if you ever see the IPO market come back, you want to buy Goldman, you want to buy Morgan Stanley, you want to buy Thermo Fisher, and you want to buy Danaher because we have a lot of biotechs being bought by the big guys, but no biotech IPOs. But until we get them, this is COVID hangover. I can't believe Danaher's at 186. I can't believe it. I can't believe Thermo Fisher's that. Mark Casper's one of the great executives. This is a group that has been thrown away as if it's never going to come back.
I know, but what is going to turn it, though, Jim? I mean, it's clearly they're having a bit of a demand issue here, right?
Well, yes, and they have an inventory destock because there's a lot of equipment that you would use if you're, let's say, making biosimilars.
Right.
And they don't have the orders. So, I mean, this is... Sometimes you buy a value stock that used to be a growth stock, and you think it's going to go back to be a growth stock. And Carl, I mortify myself and self-remonstrate when I tell the club, look, sometimes you have to just go with high quality and bet it's going to work because it always has. And right now, this is the nadir of that moment for this stock and for Disney, where this is another stock where I'm just aghast at where it is.
At Disney? Well, it's only down 5% for the year, but it's at $150 billion market value.
But where was it?
It was a lot higher at one point, yes, we know that. I mean, the next order of business for Disney's probably going to be the negotiation with Comcast over the stake in Hulu that is going to be the option that is going to be exercised by Disney to acquire that 33% of Hulu it doesn't already own. Expect that to be exercised soon. And by the way, my understanding of the process, and there's a lot of notes being written these days about value, but is that once Disney exercises the option, they will pay the floor price, $9 billion roughly, right away. So that gets paid. Comcast's going to have $9 billion, let's call it, the next month or so. Then you will have that appraisal period begin on the incremental value beyond $9 billion and what that may end up being.
Yeah, Bernstein today says that number ends up being more like 12.
Right, so another $3 billion paid, perhaps. Everybody's coming in with their guesses. The contract language, Comcast would tell you, is very favorable to them because it's not about assuming the real world. It's about assuming a world that doesn't exist, but for the purposes of the appraisal does, which is that everybody wants to own it, everybody bids as though it's for sale, and in perpetuity, Disney and Comcast are providing it programming. None of which is the case, but for the purposes of the appraisal, apparently Comcast says is. We'll see. But that's going to be next for them, Jim. And then, obviously, we're still waiting on ESPN to see if they announce some sort of partnership, some sort of equity investments from.
Look, you should point out, and I am going back and forth with management, they have the balance sheet to be able to buy.
They have the balance sheet to do Hulu.
Right, so that
they do.
You take that off the table, which is one of the reasons why I think this could be a catalyst for literally both stocks. Do you think that's possible? That there could be two winners?
It could be. Could be once it's at least dealt with. I mean, I think it's seen only as a positive for our parent. I don't want to sound like I'm a homer here, but like you're at least 9 and maybe more. The question is then what you do with it.
Well, the growth, the business
help fund losses at Peacock.
Growth. I mean, when you look at Verizon, that
Sorry, Carl.
I like the full close shave there. It's all right.
Close.
Yeah.
Close. Tomorrow I won't be here. You're off tomorrow? No, I'll be here.
Oh, yeah,
He's off.
absolutely.
Yeah.
You're
Forever.
Off. You're real off.
Yeah, I'm done.
Jim, we haven't touched on Visa. The guide, some argue, was a little underwhelming. They did have a pretty nice div hike, good buyback. Not really modeling any kind of recession into their models.
I love the quarter.
Really?
I mean, to me, I was looking at cross-border. That's all I care about. You got double-digit gains. You got Visa Direct that's obviously taking share. I didn't expect that to happen. I think the stock could be up. This is a stock that goes higher because it's the real fintech. I'm doing a piece tonight about who's phony and who's real. Well, you know, Visa's back, and I prefer to be in Visa than I would say, David, I don't know how you feel about square or block or rectangle or whatever that thing is, a rhombus. It's a rhombus.
What about the double downgrade TransUnion?
Well, that was...
By the way, wait, Square is down about 7%.
I know, that's why I mentioned
Oh, anything we should know? Because I don't.
Well, look, Affirm's down too. All the new fintechs are having a bit of a comeuppance. The TransUnion was withdrawal of their guidance, kind of a withdrawal, frankly, of their cranial power. It was really very nasty.
Very tough. The target there gets slashed from the 90s, I think, to the 50s or 40s.
Second day it got hit. You know, this is a company that does, you know, when you do this kind of fintech that, you know, kind of helps you figure out whatever, and there's other guys are coming in, and Intuit's coming in. Intuit is, by the way, a really good company. You can't compete with Intuit. Anybody who tries to loses.
The U.S. government not going to be able to compete with them when they let people do their tax. They have their own automated tax filing thing.
Well, I mean, if you want to talk about the U.S. government, have you looked at the balance sheets of Alphabet and Microsoft?
Yeah, they're very good.
They're a lot better than this country that has like the 5% going to 6%. I'll take those nation states any day. It's kind of like Medici. It's like Medici. Microsoft is Medici.
Would you rather be a lender to the Twitter LBO than a holder?
Well, no. I was on Twitter this morning praising Frank Holland for mentioning me and my Celsius.
Oh, that's right.
My
I saw
Celsius,
that. Yes.
You know, kind of I don't know. It does make you talk, maybe think a little bit faster. It has you race sometime, Dave.
Celsius. It's got a lot of caffeine in it.
Celsius.
Yeah.
It's 5 times. It's even better than Dutch Bros.
Than Dutch Bros.
Yeah, which has the Annihilator, which has always been my favorite because it keeps you up for 3 days.
Not that we can tell.
No. and if you have that in Sterno, well, that's a great combo.
We've lost whatever pre-market open we were expecting here. S&P holding 4,200. Watch bonds today. We're actually going to hear from Powell this afternoon, although Fed's in a quiet period, so unlikely he'll say much of note. For now, the 10-year just south of 4.9. Be right back.
Order partially filled. Order partially filled. Order filled.
Names can be misleading, like ours, LSEG, the London Stock Exchange Group. We could have called ourselves the London and practically every other place in the world stocks, bonds, currency data, analytics, indices, risk management, clearing, exchange, multi-asset class group. But that's a little wordy.
CNBC. Live ambitiously.
How are leaders getting their companies ready for the future?
Keep updating on the knowledge related to their professions.
Future ready means having to be where the wind blows.
On challenges.
Put a flat organization so you can actually run faster.
Expect the unexpected. There'll be lots of things coming that we don't even know about just now.
All that and more on the next Managing Asia.
Says the setup has become compelling, but a couple downgrades too. Citi cuts Etsy to neutral. UBS cuts, or actually ups Chewy to neutral, but both of those names losing some ground as the Dow's down 75. Stop Trading with Jim is next.
CNBC. Live ambitiously.
It's one of the most fossil fuel reliant economies in the world.
South Korea has been continuously increasing the share of renewable energy, striking a balance between nuclear and renewable energy while reducing the number of thermal power plants. Eventually, it boils down to how to achieve carbon neutrality. It's something the global community needs to work on to avoid a catastrophic result.
Will South Korea's plans to go green work? We find out on the next Sustainable Future.
up trading.
I want to dive into some complexity here. We know that NVIDIA has been told, look, you can't sell these chips in China. We talked about yesterday, 30-day. What's interesting is where those chips are going to go. Where's those cards? They're going to come here. And who are they going to be up against? They're going to be up against AMD and Intel, which are more powerful, which go less height. NVIDIA. Can NVIDIA charge a little more? Yes. It's a negative for Intel. It's a negative for AMD. But people aren't realizing it. NVIDIA got the customers. And I surely feel after last night's Google, yes, even though they're not doing that well, but certainly Microsoft call, NVIDIA, if you can get a card, let me know.
Yeah. Intel gets cut to 40 over at Ray J.
And that's right, because NVIDIA's going to take whatever they have. They're going to eat their lunch.
All that spending. 40 billion from this one, 40 billion from that one, 40. I mean, a lot of it's going to these guys.
Well, I got to tell you that they have the inventory. The Chinese, the Chinese. When you hear that, China, they definitely need at one point. But when you hear about all those orders that are not going, everybody wants that property. Everybody wants their stuff, and you would gladly take their stuff over Intel's. Nice as Intel is, Jensen's nicer.
So you'll have Meta to kick around tonight. What else?
Yes. Okay, so we have Waste Management. I love a stock with just plain old it's now called WM. I shouldn't call it Waste Management anymore. Mattel, I don't know. I mean, other than Birkenstock, who's the winner in that movie? I love that movie, by the way. I thought it was a winner. And then Brian DeMoore, we got to find out about used cars, which they've been plummeting in price. This shows really kind of a referendum on every single aspect of consumer and industrial. We're doing some cool stuff right now.
I like that, yeah.
Aren't we? And David, Ruth Porat, she's still the best. She had an off night.
Okay, I believe it.
Alphabet. She's the best.
Jim, we'll see you.
Like
I know you do.
For many, many years.
Yes.
Ever since she mortified me about Morgan Stanley's going to make it.
Mad Money, 6 p.m. When we come back, we will continue reaction to Microsoft and Alphabet. Also, T-Mobile's Mike Sievert, first on CNBC in a moment.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 26 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
Interactive Brokers pays up to 4.83% on instantly available US dollars in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 4.83% on uninvested, instantly available US dollars in your brokerage account. The best informed investors choose Interactive Brokers.
CNBC. Live ambitiously.
Be ready before the opening bell. Squawk on the Street on CNBC.
Order partially filled. Order partially filled. Order filled.
Wednesday morning. Welcome to another hour of Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber, live for you, as always, from Post 9 of the New York Stock Exchange. Take a look at stocks here in the early action. Some pressure. Not a lot of green on the screen. Energy is the only sector that's higher. Everybody else is lower. Communication services at the bottom of the pack. A lot of it is earnings driven and some big movers. Healthcare also under pressure, though information technology is holding up a little bit better. So mixed picture. The NASDAQ is down the worst. It's down 1.5% right now, thanks to earnings movers like Alphabet weighing on the NASDAQ overall, though Microsoft offsetting that a little bit. Tesla's higher right now. T-Mobile's higher. We're going to talk to the CEO in a bit. So a lot of earnings to sift through. We're 30 minutes here into the trading session. Here's some other movers we are watching. Boeing shares flying higher despite cutting its 737 deliveries target. CEO David Calhoun speaking with us in the last hour, saying the company is working through the challenges and will get back to the full rate by the end of the year. More on those numbers a little bit later. And then there is T-Mobile, which I mentioned is higher. IMAX shares falling on the back of their latest results. We're going to speak to the CEOs of both of those companies later this hour. And General Dynamics trading higher. The defense contractor beating quarterly estimates thanks to strong demand for its artillery and armored vehicles. Stocks up 4%.
Not a lot of data today, but we are getting new homes. Let's get to Diana Olick. Morning, Diana.
Good morning, Carl. New home sales in September took a much wider than expected jump, 759,000 annualized. The street was looking for 680. That is up 12% month to month and up 33.9% year over year. I'll say these numbers are based on signed contracts in September. That is, people out shopping during the month signing the contracts. And we did see mortgage rates actually drop a little bit in September below 7.5%. It's now that they've been climbing up in October toward 8%. So those people obviously taking advantage. But we did hear yesterday from the CEO of Pulte Group that they're buying down the mortgage rates aggressively. He said they're giving people around 5.5% on the rate. And this all happens as, of course, we know that the existing home supply at the end of September was at a record low, according to the realtors, so the builders are definitely profiting from that. The sale price, median price, was $418,800. That is down 12% year over year. So the builders are also perhaps lowering prices a bit, and also people are buying on the lower end of the market. Interesting, though, that the inventory, that is a 6.9 month supply, that's down from last month. So the builders are really going through what they have, the backlogs, et cetera. But again, this is a much bigger than expected jump at 759,000. So people are still out buying, even though interest rates are high. One thing we did also hear, I'll add, is that a lot more new home buyers, at least according to Pulte's CEO, are using cash. So not surprising. Back to you guys.
Yeah, I guess when you can, try to avoid that 8% or so mortgage. Diana, thank you. Diana Olick. A lot of earnings to get through and some commentary as far as what they say about the environment. I'll start because Diana just mentioned housing with Taylor Morrison. This is the big home builder. And here's the comments that we pulled out of this one that I thought were notable when it came to demand from the CEO. We acknowledge that the rapid acceleration in interest rates in September has once again injected some hesitation into the market alongside typical seasonal slowing. No surprise, housing is an industry that's feeling the impact of the higher rates, perhaps more than any other industry at this point. On the other side, there's the consumer. And we heard from Visa. Listen to what the CFO said about consumer spending on the call.
As we've said consistently, we're not economic forecasters. And so at a macro level, we are assuming no recession in our outlook. We're also not factoring in any impacts from Reg II and student loan repayments because, as I mentioned before, we've yet to see any meaningful impact. As the year progresses and we gather more information with regard to these assumptions, we will continue to provide updates.
If you ask Visa, they're not seeing a slowdown.
No.
And they're not expecting recession. So it really is a tale of different industries and different economies and a broad economy that is so far managing to stick a soft landing. Whether that can continue with inflation coming down, we'll know more at the PCE numbers when they come out on Friday. We'll know more tomorrow when we get the third quarter GDP, just how strong that is on the soft landing narrative. But at the time, the Fed's getting what it wants. It's getting the soft landing with lower inflation and not a break in the jobs market or a major correction in the equity market. It just doesn't feel that great. Still feels lousy.
What's the it?
Just the mood.
The mood?
The vibe.
Yeah.
You know, there's scary geopolitical things happening.
There are,
I think
and it's hard to quantify those, and it's hard to quantify, by the way, their impact as well on the capital markets.
especially when you're not seeing treasuries behaving as typical safe havens. And we're looking now, yields at 4.9. So inching back up to that 5% level. Does feel like nobody wants to step out in front and buy treasuries unless we either have more clarity that the Fed is done or that the soft landing can, that we're not seeing a bigger recession or some sort of bigger slowdown. Feels like still unknowns on those facts, and in the absence of that, yields tick higher.
Yeah, jumping higher on the back of those new home sales numbers, the best in several years. I don't know if you noticed, refis actually went up last week, 1.8%, even though mortgage rates are 7, 9 at this level. Somebody's refining.
Somebody's refining, and there's demand for housing, as Diana said, even if it's more cash deals. People, I guess, have more cash than they had in the past, and that continues to filter through. Just another strong data point. Guys, as far as the direction of treasuries, obviously next week's going to be key when it comes to the Fed. We've got a Fed meeting, we've got a Bank of Japan meeting where there's a lot of anticipation. There might be a change there. But you know what the biggest event is? And I can't even believe I've never said this.
Oh.
But there's on Wednesday morning.
Is it F1?
At 8:30. No, that's the biggest event in the world.
It goes
we can talk
Fed
about that.
And then F1.
Yeah.
All right. Well.
Exactly. There's a Treasury refunding announcement. So the Treasury comes out quarterly, every 3 months. The last one was July 31st, and says how much debt it's going to issue and in what type of coupons and
over
maturities.
The next quarter, is that?
Over the next quarter.
And I think you pointed out, or somebody has, that the last time they did that, the market's been trending down since then?
Canaccord Genuity, Tony Dwyer said that the S&P topped on that at that time at the end of July. Because this whole fixation with issuance and supply and demand and term premium is very much in focus and could be a big reason why we're seeing these high yields.
So that's next week.
It's Wednesday on Fed Day, but in the morning. And again, it's usually like a nothing. We don't care, but we will get all the auction sizes, and so we'll see like how Treasury Secretary Yellen is planning to structure it and how much she's. Last time it was they wanted to borrow $1 trillion over the months. In the meantime, we just digest these earnings and we try to make sense of what's happening with demand. I mentioned Visa. We have a number of others we can get to. What's happening with the luxury consumer? Kering gave us a good snapshot. This is the parent company of Gucci, for instance. Cracks in that picture, I would say. If you look at some of the commentary there, what we see so far in North America, not Gucci specific, is rather clearly, unfortunately, some pressure on the traffic. I mean, traffic has been clearly weak, and we don't see really an inflection point for now on the traffic. Love that. The French honesty.
Yeah. Well, they're not the first. I mean, we've seen a number of the highest end luxury start to talk about slowing.
Hermes was good.
Hermes was good, but
LVMH
was.
But there you're talking, and we talked about that last week, where the size of the business has tripled in like the last 7 years. It's impossible to keep growing revenue at 30% in a storied name, even.
Yeah, and the fact that they're pointing out, we knew China was weak, but they're pointing out the North American traffic here, which I thought was notable and could be new because the luxury sector's held up better than everyone else. And then there's just the industrials and the movers and the transports and the economy. We just got in the last hour a comment from the CMO of Norfolk Southern, the big railroad, on the earnings call. Here's what they're saying about the environment.
For the fourth quarter, we expect to see slow volume recovery amid uncertain economic conditions. September presented us with some encouraging data that the contraction in manufacturing is slowing and onshoring to the U.S. is on the rise. However, we remain cautious in our optimism as uncertainty surrounding future Fed actions, strike outcomes, and geopolitical tension is very pronounced.
So how's everyone dealing with the higher rates? They're all cautious. They're all on guard. They all talk about the uncertainty, but nothing appears to be collapsing, is how I would sum it all up.
All right. Shares of Alphabet don't appear to be collapsing, but they're not doing very well, down over 8%. It's a tale of two tech titans this morning. Microsoft's cloud business accelerating, but Alphabet, well, those disappointing cloud results overshadowed what was an earnings beat. Strong numbers on the ad front, for example. Our next guest joined us just a couple of days ago. He did warn of, quote, tension ahead in tech. Microsoft remains his franchise pick. Brent Thill, Jefferies analyst, joins us now. Buy ratings on both. A good choice on Microsoft as opposed to Alphabet, at least in terms of franchise pick, Brent. But let's start with Alphabet. Stock's down 8.2%. Obviously worries about a decline in the growth rate at cloud, which differed from what we saw at Azure, Microsoft's cloud unit. What's going on there? What did they say on the call that got your attention, and what does it say about the future?
Google's losing share in the cloud. Their market share and the growth rate went from 28 to low 20%. And in infrastructure, they're 1/3 the size of Microsoft. So that tells you a lot. They're a lot smaller than Microsoft, and they're decelerating massively. Microsoft, on the other hand, accelerated and is seeing AI starting to boost their stream of revenue, and that's going to have a bigger impact in the next couple quarters. So pretty clear what's happening. Google's an advertising company. They've struggled from the outside for a while. This is really a two-horse race. It's Amazon and Microsoft, and the rest of the industry is looking in on those two. Google, Oracle, they're all trying to battle to get in and get their hands on enterprise cloud. And we think they're doing a better job, but they are not necessarily becoming the prime. The prime is going to be Microsoft and Amazon. And it's, I think, as simple as that. The Google advertising numbers were fine. YouTube,
yeah, they were good. They were strong.
Phenomenally well.
Yeah, all right. I don't want to get too off topic, but I am curious as to the read-through then, in your opinion, from Microsoft's cloud to AWS. Is that a positive then, as we hear from Amazon later in the week?
I think it's a positive in the sense that overall cloud demand's coming back because you have to move to the cloud to get ready for AI. I do believe that Microsoft is in a stronger position in taking share against Amazon. Remember, Amazon won round one of the cloud, $85 to $90 billion plus run rate in cloud, but they have lost the AI chatter initially. This is early, but Microsoft jumped out, remember, at the beginning of the year, and was the lead horse in the AI rhetoric. So we think Amazon's got a lot to prove on AI. We're hearing good things about Bedrock and some of their AI services. They're starting to make their way back in, but they are the leader in cloud, and we do believe that they will have good things to say. I don't think it's going to be as positive as Microsoft, because remember, Microsoft just has so many sources of revenue that's surrounding this AI story. They have the application portfolio, the cloud, the developer tools. Amazon's got a subset of that business. So I don't think it's going to be quite as strong as Microsoft, and I don't think it's going to be quite as weak as Google. So put it right in the middle of what Google and Microsoft said.
Concern about Google's spending. Do you share in that? You know, I played earlier a comment from Ruth Porat in answer to an analyst question from the call where at least some people have pointed to it and said it didn't give them reassurance that, in fact, revenues are going to outpace spending in terms of growth.
Well, they're behind, at least in the enterprise AI race, and behind in the cloud, so they have to spend a lot more to catch up there. So that's pretty clear. We think, again, they're more optimized. They're seeing better efficiency as it relates to some of the other advertisers. So we don't necessarily worry too much on the expense side. On the advertising side, on the cloud side, they're going to clearly have to lean in harder to catch up to Microsoft and Amazon. So that is absolutely clear. But I don't have a big spending concern at Google from what we can see at this point.
Okay. And finally, read through to Meta, which also is going to be reporting very soon on the ad side. Is it seen as a positive, or any takeaways from Snap's comments that things may have slowed a little bit as a result of advertisers pulling back given the Mideast war?
Meta and Google are taking market share. Yes, there's a pause. There's no question. Some advertisers are going to take a break given what's gone on, and that makes sense. But Meta, in a fundamentally position, is in a great spot, continuing to accelerate growth. Advertisers saying they're gaining share. The stock has backed off the metaverse and lean a little more into AI and chatbots. The more he does that, the stock's going to continue to go higher because no one wants him to chase the metaverse. So we think they've done the right thing. Stock's up, obviously, massively this year. The biggest concern is just the guide on expenses. As you know, they always come out really conservative on the next year. We're going to get that guide, and he may come out super aggressive on expenses. We don't know, and that's the biggest issue. Nothing fundamentally we see right now is troubling what we see in our fundamental view, and the stock's still cheap.
Where are you on OpEx then for next year? What number are you using?
I don't have the numbers right in front of me, but
I know the $100 billion number seems to be a key here.
100 is the bar in terms of the bogey line, and I think that's that's kind of the bogey line. If they come in well above that, people are going to be concerned. at this point.
All right. Brent, always appreciate the insights and the update. Thank you.
Thank you.
Got some news out of Apple a few moments ago, raising prices of its subscription bundles. Apple TV goes from $6.99 a month to $9.99. Also raising some prices on Arcade and News Plus. Those are the first price increases since their launch in 2019. But for Apple TV Plus, it's the second bump in a couple of years. That's a 43% bump in the monthly on Apple TV.
That is. I mean, let's not forget that Netflix obviously has been raising price, cracking down on password sharing, and still had enormous sub growth, separating itself, really, Netflix did, from everybody else, it would seem, in the sense of the way it's considered by viewers sort of to be the new TV. I always come back to the fact that shows that existed on other platforms for years suddenly become most viewed on Netflix, which sort of shows. But back to Apple, they continue to sort of go for the high end, Carl, and spend money.
They got messy.
They got and Scorsese's movie.
Yep.
That doesn't come cheap.
No, pretty nice open, but not enough to compete with Tay-Tay.
Yeah.
Sorry.
No, if you can get Taylor Swift, you can charge whatever you want.
That's exactly right.
All right, meantime, to the rest of the world, we're going to continue to, we obviously continue to monitor for you the Israel-Hamas war. NBC's Jay Gray is live, as he always has been, with us in Tel Aviv with the very latest. Jay.
Hey, yeah, and let's talk a little bit about the politics surrounding all of this. 12 of the 15 members of the UN Security Council voted yesterday in favor of a limited ceasefire, a humanitarian pause, they would call it, to deliver aid to that area, desperately needed aid. There was one lone dissenting vote, and that was the U.S., saying it didn't vote for the measure because it didn't include language outlining Israel's right to self-defense. So there is a real back and forth that is growing in the global community about what to do with regards to the humanitarian aid on a day when the UN group that provides the most aid in that area, in the Gaza Strip, has said it's going to have to close things down, that they can no longer provide any support for those who are trapped in the fighting there. There are 600,000 displaced people in Gaza that are receiving aid from UNRWA, that organization, in 150 of their facilities. And today they are saying they have simply run out of resources there. And we do know that another group of trucks has moved through the border crossing at Rafah today, bringing in more water, more food, more medicine. The problem is there's not going to be hospitals to use those medical supplies to administer that medicine because they don't have the fuel to keep those hospitals open right now. The hostages, more than 200, remain in Gaza. Many of them, as we've heard from the 4 women released in some of those underground tunnels that one of them described as spider webs running underneath the city. Qatari working as a middleman in negotiations for the release of these hostages, and say the talks are continuing, and they've continued at an accelerated pace right now. They say they do have hope that there could be a significant agreement to release a number of the hostages at some point soon. Of course, all that going on through backdoor channels. And let's talk a little bit about concerns of the expansion. We've discussed this in the past. You continue to see the fighting back and forth between Israeli Defense Forces and Hezbollah fighters on the Lebanon border. We know that Syria has been an issue today. Israeli airstrikes killing 8 Syrian fighters in a skirmish there. And we know that the U.S. continues to move assets into the area as a deterrent to things expanding here. To this point, though, guys, it has not slowed down the back and forth and the concern. Remember, Israel is a place, a nation that is surrounded by adversaries, and this is a very tense situation across the board, Sarah.
Jay Gray, thank you very much for the update. A lot of moving parts in Tel Aviv today. As we head to break, here's our roadmap for the rest of the hour. T-Mobile dialing up a profit beat and raising its free cash flow forecast. The telecom giant CEO joins us first on CNBC next.
Plus, IMAX, it's on the move after record results. Revenue jumped more than 50% from a year ago. We will break down the numbers. CEO Rich Gelfond will join us in an exclusive you don't want to miss.
Finally, around 50% of the transports report earnings in the next couple of days. We'll take a closer look at whether that group is at a tipping point and what it might signal about the health of the economy in a moment.
CNBC. Live ambitiously.
We're at the beginning of one of the biggest tech booms in the history of technology.
The opportunity for us, all of us, is to do those things which we know to be profit generative, yet not societally disruptive.
We were all surprised during COVID to see that most of our pharmaceuticals were manufactured in China.
Zelensky wanted to meet people from the business community. What he really had to say was, don't wait till after the war. You can really help us by bringing business to our country now.
Watch it now on demand at deliveringalpha.com.
Welcome back to Squawk on the Street. T-Mobile posting mixed results. The wireless carrier also raising its free cash flow forecast after quarterly subscriber additions did top estimates. Joining us here now at Post 9 in a first on CNBC interview is Mike Sievert. Nice to see you.
Great to be here, you guys.
So I guess revenue was good if you look at services revenue, which is what matters, and the additions were good. What is, I mean, we always ask this, what is driving growth in this industry?
Well, you know, this is another quarter showing that our strategy, which has been so consistent, of delivering the best network and the best value, is delivering reliable, consistent growth, both at the top line and the bottom line. Service revenues consolidated will lead the industry again. Postpaid service revenues, which is where most of the value is created, 6.4%, about 1.5 times peers. And so that's really great to see, and that's translating into double-digit EBITDA growth. Cash flows up 94% year over year, with lots of room to run, as we talked about in previous outlooks for next year. So we're just in a great spot where what we have to offer is unique, and that's translating into results for our customers and as well as for our investors.
What's going on with pricing? There's this narrative in the industry, and there's been some excitement around Verizon and AT&T. They were coming from a much lower valuation, that maybe pricing is moving up, that there's pricing power, although you shot down a report, I think, on the conference call this morning that you were looking at a price increase. What's the story here?
Well, ARPA, average revenue per account, is rising. This quarter, we were up more than 1% versus a year ago. And what's happening is customers are self-selecting up our rate plans because they want more of T-Mobile. We're delivering a fantastic network experience, and our new Go 5G Plus rate plans, which happen to be at the higher end, are also our most popular. So revenue per account's rising, and that means we don't have the same need that others might to slam customers with surprise pricing.
So you're not looking at raising prices?
We're always looking at ways we can rationalize our rate plan structure. We have lots of old legacy rate plans. We may look into whether or not we can simplify, whether customers will appreciate and accept new plans. But it's, what we're finding is that our most popular plan, 60% plus of new loading, is Go 5G Plus and better. And that's amazing, that we're attracting some of the best customers in the industry now with payment rates better than our peers and prime credit customers at all-time highs for T-Mobile.
Mike, a lot of focus on the iPhone 15 launch. Typically a launch like that or a new product gets switching few upgrades. On the call, you said you feel fantastic about it, but you did admit when you look at upgrades, it's a little lower. The upgrade rate at 2.7% is a little bit lower. So what's going on there? Why do you feel fantastic if, in fact, things are not coming in perhaps where they have in the past?
Well, remember, if you can have low upgrades and low churn at the same time, that's the trifecta, because upgrades cost a lot of money. And, we in this industry, because of all the competitive intensity, we subsidize phones to a great degree, including for existing customers. And what T-Mobile does is successfully, surgically provide upgrades for the customers who want them most. And remember, day to day, T-Mobile customers are having a much faster 5G experience, twice the speeds, even after all that C-band deployment of our competitors, twice the speeds of our competitors on 5G. So they just don't have the same impetus to upgrade as fast, and we're beneficiaries of that because those you want low upgrade rates and low
You're
churn.
a beneficiary. I guess in part, though, our audience also cares about Apple for obvious reasons. I mean, how would you characterize the launch of the 15?
Well, I would say it was a big success in that it did drive switching for us. And one of the things that's interesting is this new iPhone unlocks advanced network technologies that only T-Mobile has. So we have what's called I'm gonna geek out on you, four-way carrier aggregation. That means the phone can talk to 4 different bands of our network at the same time. It's a breakthrough for an iPhone, and we're the only ones that have it. And that's gonna feed even more speed and performance for T-Mobile customers relative to our competitors, which might mean that these low upgrade rates for us will have some durability into the future.
Is growth, some analysts had questions about taking share in rural markets versus urban. Can you talk about the difference between the two?
First quarter ever where we were the switching leader in rural markets. Remember, this is an area where we started focus on 2 years ago. We were never really big players in rural. And this is not just tiny towns. I'm talking about 40% of the country, everywhere except the top 100 markets. We were dead last. And we said we'd get to 20% by next year and that we would eventually be the leading share taker. And this quarter, for the first time ever, T-Mobile was the leading share taker across that entire 40% of the country, while also being the leading share taker in the top 100 as usual. Just a fantastic breakthrough for us.
What about the cable competition? They're clearly taking wireless market share. You've called it, I think, low calorie when it comes to some of those prices, but at what point does it threaten you and threaten the entire industry on the pricing model?
Well, I can't speak for others, but cable's been remarkably consistent over the past year. There was a step up about a year ago, but it's been remarkably consistent since then, and you've seen some of the best performance ever in our history. Q2, our best quarter ever. Q3, our best Q3 ever in terms of churn. This quarter was the best Q3 we've ever had in terms of churn in the face of that very competition that you're speaking about. So we're performing through it beautifully.
So it may not be affecting you as much, but it's certainly affecting the broader industry.
It comes from prepaid, where again, we're growing in prepaid, 79,000 net adds this quarter, but some others lost big time. I think some of that went to cable. And it's growing partly from switching from others. And I think some of it is that low calorie ads that we talked about, people maybe low usage lines, stuff like that.
Mike, for the first time in a while, people asked me to ask you about M&A. I guess you were asked maybe even on the call and didn't say no. U.S. cellular assets are out there. There's some who think you might be interested, or even Frontier, which I find a bit hard to imagine. But I'm curious, is it something you're actively looking at?
We never don't look. But I have to say, we love this strategy we've got now. So the bar is very high. This business is firing on all cylinders. We're in the middle of a fantastic shareholder return program from mining years and years of investments in creating this pure play wireless company that truly delivers incredible value. And so the bar would be high. But we are interested in fiber and broadband. But so far what we've said is we're interested in doing that through partnerships, collaborations, investments, generally low capital, off balance sheet approaches. So maybe we can have it both ways. We can bring our brand to this space and make money and deliver something great for customers, but not change who we are from a capital structure standpoint.
You talk a lot about broadband. You seem very fixated on the growth opportunity here and the potential convergence, right, of broadband and mobility.
6 quarters in a row, we have been the broadband leader with more net additions than AT&T, Verizon, Comcast, and Charter combined.
Fixed wireless.
So of course we're excited about it.
Yeah.
Broadband overall. What we offer is fixed wireless.
Right.
All right, Mike, thank you.
Great to see you.
Well, good to have you here. Mike Siebert, CEO of T-Mobile.
Still to come, about 50% of the stocks in the Dow Transports report earnings today and tomorrow. So we're going to take a closer look at what those companies could be signaling about a recession and whether the stocks may be worth a look right now. Don't go anywhere.
We empower those who act, those who see the correlation between predictability and probability, those who manage risk by anticipating each movement, flawless execution, timing, and accuracy. Identify the goal, match power with precision, reach new heights. See where risk meets opportunity.
And we always try to diversify our risk. This is not leaving a country or leaving a specific region, but we diversify, of course, our risk. We need to do that anyway because, especially Neue Klasse, it will not be a small volume. So we need, from the large suppliers, we need more than one anyway, but we are neither leaving China nor do we leave another region.
Welcome back. I'm Leslie Picker with your CNBC News update. Michael Cohen is back on the witness stand in his $250 million civil fraud trial this morning. In his first day on the stand Tuesday, he claimed Trump directed him and the former CFO of the Trump Organization to inflate his assets. An Australian judge ruled Carnival was negligent when it did not cancel a 2020 voyage from Sydney that led to a major COVID-19 outbreak on board the ship. 663 people fell ill after it departed just one day before Carnival began offering free cancellation for its cruises. 28 people died. Richard Roundtree, who played the iconic Private Eye John Shaft in the Shaft film franchise, has died. The role earned him the title as the first black action hero in cinema. Roundtree's manager says he died from pancreatic cancer. He was 81 years old. Back to you, Carl.
Leslie, thanks. We're going to get some of the more important reads on the economy in the next 24 hours. Roughly 50% of the transports report today and tomorrow morning. Our Frank Collin, I think, is watching some of this as the index, at least, Frank, has not been pretty lately.
Right. Yeah, not at all, Carl. We've seen some big downturns when it comes to the Dow transports, and as you can see, transports, they're off their highs of this year. They're underperforming the S&P 500 and the NASDAQ. Remember, transports are often seen as a recession indicator if we see a sustained downtrend or that index turn negative. So the next 24 hours could be a major inflection point with just about 50% of the index weighting reporting earnings. We just had earnings from Old Dominion, a trucker with the highest weighting in the transports. Those shares lower. Norfolk Southern and Ryder also lower, reported this morning. UPS reporting before the bell tomorrow. So here's what we know about the overall transport landscape. Rail volumes, they're down 4% year to date. We've seen a modest upswing in recent weeks as we near the holiday season. Bit of a mixed picture for trucking. Rates are more than 20% lower year to date. A choppy recovery in recent weeks with the bankruptcy of Yellow boosting rates. That disruption and the averted Teamster strike at UPS, two major factors in the price action. That's why Milken chief economist Bill Lee says it's really time to rethink how we look at the transports.
So these indices as an overall predictor is something I'd be very careful about, but it gives you information, right? If you can isolate the company-specific events.
So here's a look at where the Dow transports, where they stand right now. You can see they're only up 3, almost 4% year to date. Just yesterday, they were up about 6.5% year to date. So an interesting 24 hours if you do believe that transports can give us an indication of an upcoming recession. Sarah, back over to you.
All right, Frank, thank you. Frank Holland. Up next, Apollo's chief economist, Torsten Slok, why he says rates could head higher from here, at least according to one measure. Don't go anywhere.
CNBC. Live ambitiously.
When the closing bell rings, we're just getting started. Market analysis, insightful interviews.
What public companies do you think are best positioned to actually make gains during this period?
Closing bell overtime on CNBC.
I think there's something for the Bulls and the Bears in this one as well. Posted an 8% drop in third quarter profits. Some analysts say not as steep as expected. Revenue, though, falling at the investment bank, despite the corporate and retail divisions looking pretty solid.
What's going on is the normalization of fixed income and currencies revenues that we called for, especially in the macro businesses, so rates, foreign exchange, and emerging markets, where they had benefited last year from the very high levels of volatility.
As discussions of how restrictive monetary policy is should not only look at the level of the Fed funds rate, but also include forward guidance and balance sheet policies. Apollo Global Management Chief Economist Torsten Slok joins us now. Torsten, what do you mean? Are things a lot tighter than we're thinking that they are?
Well, that's a very important question, Sarah, but the Fed has this calculation where they say it's not only about the Fed funds rate. And it is also about the other tools that they have in the toolbox, most importantly about balance sheet policy and about forward guidance. Remember, those were new tools that they introduced after the financial crisis in 2008. We never really had the balance sheet or forward guidance playing the major significant role that it does today. And when you quantify the impact, in particular, of course, the balance sheet of running down the balance sheet as they're doing at the moment, they do find in their own calculations that the Fed funds rate today is not only 5.5, but it's actually 7. In other words, policy is a lot tighter than what they and we all think, simply because the other tools that they have are also helping in putting downward pressure on the economy.
And yet, the economy is hanging in there quite nicely.
That's right.
And a lot of the data recently has come in better. And even though Powell was kind of neutral when he spoke last week, he said there's evidence that it might not be tight enough.
I know it is, honestly, quite incredible how resilient the U.S. economy is. There are signs for the consumer. We are seeing delinquency rates going up on credit cards, delinquency rates going up on auto loans. For firms, we're seeing default rates going up for high yield quite quickly in the last 6 months. And finally, for banks, we're also seeing bank lending in the weekly data slowing down. So consumers, banks, and firms are beginning to see more and more impact of the Fed hiking rates, but it still has to bite harder and harder on those three different fronts, and including the data we just got this morning on new home sales. It is quite surprising also how resilient the housing market is, because we're still having quite a headwind. We continue to talk, all of us, about rates being so high. So we still have to wait a little while longer, but it will ultimately happen that we will begin to see a slowdown. That's what the Fed needs to get inflation down to the 2% target. Remember, core CPI today is 4.1. So we're still not there yet before the Fed, they can begin to take it more easy. They still need to be hawkish.
Yeah, we'll get the PCE deflator on Friday. Torsten, I think the other sort of silver lining to all of this is that if we do go into recession or we do face more increasing economic pain, they've got tools. We've got interest rates that are not zero anymore. We've got a balance sheet that has shrunk more than $1 trillion. They have levers to pull, whereas they haven't in the last 10 years or so.
That's a very, very important point for markets. Think about this recession that we also worry about, and that is likely, in my view, coming on the horizon. This is something, the slowdown that we are talking about here is engineered by the Fed. This is manufactured by the Fed. The Fed is trying to slow the economy down, to slow inflation down. This is not like the previous recession. Of course, it's not like the pandemic that came literally out of the blue. It's not like in 2008, where there was a huge imbalance in the housing market, in the banking sector, on consumer balance sheets. It took time to clean up after those imbalances. Likewise, if you go back to the previous recession, which was the tech bubble, it also took time to clean up after the tech bubble. But here today, this is all engineered by the Fed, this slowdown. So if things start to slow as they want, they will begin to turn around, and therefore the slowdown is probably going to be milder than what we have seen in prior recessions.
Torsten Slok, good to talk to you. Always good to get a read about what you're thinking about. Torsten Slok from Apollo.
Getting some breaking news on the FTX trial. Let's get to Kate Rooney with that. Hey, Kate.
Hey, Carl. So Sam Bankman-Fried, the defendant in this case, does plan to testify in his defense. His lawyers just got off a phone call with the judge. They say they're going to present 3 witnesses and their client, Sam Bankman-Fried. It speaks to his risk appetite, guys. This is not expected in these high-profile criminal trials. Most often, the defendant does not testify. It is seen as a Hail Mary here, but he has had 3 close inner circle top executives testify against him. The evidence is mounting, so it's being described by legal experts as a bit of a Hail Mary here. But we do expect to hear from Sam Bankman-Fried on the stand in the coming weeks, guys. Back to you.
The question, Kate, is whether or not this would have happened if Ellison's testimony hadn't been so damaging in the eyes of some.
That is what we're interpreting this as, Carl. So a lot of the legal experts out there are saying that between Caroline Ellison, Gary Wong, and Ashad Singh, his 3 not only top executives, but really his former girlfriend and 2 best friends, the evidence is really massive at this point. And they got 3 firsthand eyewitness accounts of his closest confidants. He's going to want to get up there and tell his side of the story and try to refute some of what the jury's heard. But again, a big risk. He's subject to cross-examination by the government side here. So we'll see. But again, very much a Hail Mary here. Back to you.
That's a big turn. Kate, thank you. Kate Rooney this morning. When we come back, IMAX with its second highest grossing quarter ever and a big revenue rebound. Shares are a bit lower today. We're going to talk to CEO Rich Gelfand about the road ahead, what some of these production delays might mean for 24 when we're back in a minute.
Order filled. Order partially filled. Order filled.
Across the globe, industries are transforming. And businesses need to navigate the changing landscape to stay ahead. When you partner with Barclays, every change leads to a bold possibility. You have the vision. We have the insights, financial solutions, and global perspectives to help you make it real. Barclays Corporate and Investment Bank. Powering possible.
CNBC. Live ambitiously.
Nick Bugazzi on hosting SNL.
Really waiting for them to be like, we're not going to air this. Like, I'm just some trial show that they're like, we just wanted to make sure the cameras work.
Broadway actor Andrew Rannells and author Jasmine Ward.
Shares giving up some gains after a Q3 beat. The company recorded its second highest grossing quarter at the global box office. IMAX CEO Richard Gelfond joins us exclusively to talk about the quarter and more. Rich, great to see you this morning.
Great to see you too, Carl.
Revenue up 51. That's pretty big. How much of that was Oppenheimer?
Well, Oppenheimer certainly helped the quarter. We're over $180 million of that. But a lot of things happen. You know, I know there's a lot of issues in China, but we had a very big summer box office there. A film called Creation of the Gods did over $30 million. We've had a very diversified content slate recently, as you know, Taylor Swift. You guys have talked about that a lot. From Apple, Killers of the Flower Moon did very well this past weekend. You know, we're firing on all cylinders, Carl. It's not just Oppenheimer, it's a lot of things.
I know you were asked about the movement in the 24 slate just this week, MI8 getting pushed back. Your argument is that it sort of opens windows for other things. Is that right?
Yeah, well, it turns out one lucky thing for us is that Dune 2 moved out of November. And what that enabled us to do was to play the Marvels and to play Hunger Games and to play Napoleon from Apple a little bit longer, because we could only play one movie at a time. As a result, Dune 2 now is an anchor for our 2024 slate. It comes out in March. So it actually opened opportunities. Again, since we only show one movie at a time, we're not an exhibitor, so we don't need to fill a 20-plex. And there's just lots of opportunities out there.
Rich, it's David. What about those who do need to fill, I don't even know if they have 20 plexes anymore, but who need to fill these? I mean, what is your just sense as somebody who knows the industry well in terms of that vacuum and how big it's going to get before this actor strike gets resolved?
So, David, it all depends on when it gets resolved. So if the first half of the year, there's a lot of content that's pretty much locked. It's the second half, things that need to be reshot, and obviously you need the actors for promotion. So I think if it settles in the next month or so, it'll be okay. There'll be a little bit of a negative fill for exhibitors. But I think if it drags on till the beginning of the year, then it's a more serious issue for them. Again, for us, most of our year is locked because we play one blockbuster at a time. It's not that I still care about it, and I do think it's likely to settle in the nearer term rather than the longer term. But I think the exhibitors have an issue if it drags on.
Well, in the meantime, you've got Taylor Swift, and you mentioned what a bonanza that has been. Is this a new model, the concert films, or is this something that only she can do?
A little bit of both. I think we're doing Beyonce also, which is coming in early December, but I think there are a few global artists that can really, with limited marketing and afford to film it themselves, pull off that kind of a global event. I think, however, it does open the door to a lot of what I'd call local events. So there's big music stars in South America. You can do an event there. There's big music stars in Europe. We did an event in France with Indochine about a year ago, and it was enormously successful. So I think the model works, but probably not on the global scale that Taylor Swift did.
Rich, good to have a chance to talk about the quarter. Certainly it's going to be an interesting 24. We'll talk a lot more between now and then. Thanks. Good to see you.
Thanks, Carl. It doesn't get better than this. Thanks, Carl.
That's depressing me now, Rich.
By the way, in the list of my priorities, which you mentioned, Fed, F1, Taylor Swift, I think, all at the top. Coming up at 11, CME Group CEO Terry Duffy, fresh off the earnings call as his shares fall despite a profit beat. He's going to join us to break down what they're seeing across the markets that are traded at the CME Group in Chicago. Don't go anywhere.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
CNBC. Live ambitiously.
We've got stocks down, NASDAQ in particular, as we close out this hour. Let's get over to Dom Chu. Certainly a lot of names today that reported earnings, Dom, some of which we haven't hit, so we're glad you're here to do that for us.
All right, so yes, David, I'm here to help. I'll see if I can get through these in the time that we have left. We'll start with shares of Norfolk Southern, which are lower right now after the rail giant's earnings missed analysts' expectations. The company, by the way, also took a $163 million charge related to that Eastern Ohio freight train derailment that happened earlier this year. Those shares down 3%. Medical equipment manufacturer Thermo Fisher Scientific in negative territory after cutting its annual profit forecast. The company saw lower demand for its therapeutics and vaccine services. That's overshadowing a beat on the profit for the quarter here, so those shares down 7%. Turning now to Penske Automotive, which posted a beat on revenues but a miss on profits. The truck rental and transportation services firm saw lower earnings from its UK unit alongside higher interest expenses. Those results are overshadowing strength from its North American automotive and commercial trucking operations. Penske down 2%. Shares of exchange operators CME Group also lower on the day so far. The company's third quarter profits did grow, though revenues came in below analysts' expectations. The derivatives giant also noted strong performance in its bond-related products and growth in agricultural, energy, and options products. CME Group just about flat on the session. And by the way, don't miss CEO Terry Duffy coming up in the next hour on Squawk on the Street. And then we'll cap things off with Texas Instruments under pressure right now after revenues came in lower than analysts had expected. The chipmaker's forecast was also disappointing, due in part to weakness in the industrial market. Now, one bright spot was in the automotive segment, with executives telling analysts that they do not expect demand trends to change even with the ongoing UAW strike. So Texas Instruments down roughly 4%. David, I'll send things back over to you.
Dom, great job there. Thank you for hitting all of those. I'll come back to the one that we certainly led the show with, or we at least led the 9 with, which is Alphabet, of course, having the most pressure, one would think, on the NASDAQ overall, with that stock down, some 8.5%. Also got shares of Apple that are just not been performing well, despite the fact, of course, that we have yet to hear earnings from Apple. But you heard our conversation with Mike Sievert earlier from T-Mobile. You know, some questions about demand for the iPhone 15 certainly seem to be out there, not to mention always questions about China and so many other things involving what is still by far the largest market cap company at $2.7 trillion. That does it for this hour of Squawk on the Street. Another big hour coming your way right after this.
CNBC. Live ambitiously.
Wednesday morning. I'm Carl Quintanilla with Sarah Eisen live at Post 9 of the New York Stock Exchange. CME CEO Terry Duffy's with us this hour. We'll get a breakdown of earnings, trading activity, and the impact of high rates across the markets.
Speaking of higher rates, dismal comments from housing CEOs on the calls today, while they're calling this property market the worst in decades.
Later on, what can the Fed do about the deficit? Absolutely nothing, according to the Journal's Greg Epp. He's going to join us this hour.
Kick it off, though, with the market, as we always do. There are some pockets of green that have just emerged in the last few moments or so. They're in defensive groups like staples and utilities. Everybody else is red. Communication services at the bottom of the market today. That group is down 4.8% because of Google and Alphabet. A sharp negative reaction to earnings there. A big weight, obviously, on the NASDAQ as well, which is down 1.4%. Alphabet's going to be the bottom performer. But you've also got weakness today in Amazon, in Apple, offsetting some of the strength in Microsoft off earnings, and Tesla. When it comes to finding opportunities in the market right now, our next guest says steer clear of utilities and large cap value, bullish instead on select tech and industrial mid caps with an eye on rolling recessions hitting a variety of different industries next year. Joining us here at Post 9, Citi Global Wealth Chief Investment Strategist Stephen Whiting. And it's an interesting idea to not just worry about overall recession, but rolling recessions in industries, because what you hear and what I've tried to capture from certain companies and industries is very different, whether you're in housing or in travel.
Well, absolutely. And look, 2 years of below trend growth feels awful, but it's going to accomplish what a shallow 6-month recession will. You know, I think that the labor market, which has outgrown the economy last year by the most since 1974, is heading to a slowing next year. I think profits, which fell over the last 12 months, are going to gain some ground. It's probably going to take 2 years rather than 1 year to get that big 12%. So it's going to be longer, and rolling recessions, you know, you talked about real estate for a moment. Multifamily housing, it's about to deliver 1 million new housing units. All of this was planned 3-4 years ago at zero rates. That's a piece of the housing market and real estate that's going to weaken the economy next year. But trade, manufacturing, single-family housing, these are all deep in what looks like a very recessionary contraction.
So play the stocks according to how industries are impacted by rising rates?
You know, when I think about like today, this is a bad market. We're getting tightening financial conditions. What the Fed does is it raises yields, it lowers stock prices, it pushes up the dollar, all of that. But it's going to give us a good entry point. And when I think about that, the fact that growth stocks outside of the very largest ones have been left behind. We're talking about for mid-cap profitable growth companies, not the ones with the highly leveraged balance sheets in banks and REITs. But again, those growth companies that don't have a lot of debt are trading at about 15 times trailing earnings. The 25-year average is 21 times. That is very rare to find an asset that's trading cheap to its own history. And look, around the world, when you have bond yields in Japan and Europe that are not about to join the 5% club, we can use some of our asset allocation over in U.S. assets like SMID, even if the environment isn't wonderful.
Russell's closing in on a 20% drawdown. You're interested in small caps as well?
We are interested in small caps, but being specific that Russell 2000 works when we've had that V-shaped collapse in the economy. Some of the firms just managed to survive, and then they bounce back a lot. We were overweight Russell 2000 in 2021. That's not where we're going to go yet. We're going to go in a lower risk, growthier, higher quality version of small caps. And again, you can do this with S&P 400 and 600 industries. And again, if you shift away from banks and financials, which could have their day, I think you can find that there are a lot of areas. Cybersecurity companies, again, as an industry that are not, trillion-dollar behemoths, that are really growing and really outperforming what could be a 5% yield.
What about healthcare? Where does that fit in there? Typically defensive, not performing too hot.
Well, this is the thing. Pharmaceuticals were our largest industry overweight last year. 2022, stock market's down 20%. U.S. pharma was up mid-single digits for the year. Everyone crowded it and sat in it. They could perform a bit in a down market, but it's still a relatively crowded trade for us. When we think about taking risk for the next 2 years, medical equipment looks like something that's been beaten down. And these are not only, again, unprofitable companies.
Oil is down 10% from even in the midst of what's going on in the Middle East. How do you think geopolitics buffets the markets in 24?
Really fascinating, because in more than 90% of cases since World War II, these regional conflicts and shocks have not changed the direction of the world economy. And you got to be prepared in the event that it does. But it's a tail risk. We're looking at Western energy companies and saying OPEC has cut production more than American producers have raised production, right? So they're giving a benefit again to Western energy companies by doing that. It's going to mean that some of the alts, it's going to mean that some of the things that we depend on, like electrification through copper, these things will be stronger because the oil price, we talk about recessions, the oil price has averaged $24 a barrel after the last 4 recessions. It's not going to be this time, I think.
No, doesn't feel like that's the direction. Stephen, thank you for joining us.
My
sharing
pleasure.
your advice that you give to clients. By the way, Carl, things are improving. The Dow's gone net positive, and within the S&P, you've got groups now like information technology and financials joining in the green camp.
Yeah, we lost Boeing there for a moment. That kind of threw the Dow into a spin. Meantime, let's turn to the latest in Washington. The vote for House Speaker is expected in less than an hour. Our Emily Wilkins is in D.C. Mike Johnson is the 4th nominee, Emily, in 3 weeks.
And they're hoping that he is the last, Carl. Last night, Mike Johnson, he got the votes to become the nominee, and then Republicans did something a little bit different. They actually opened the doors to the room. They were in. There was Mike Johnson and a lot of Republicans behind him, and they were like, look, we're united. We're ready to get to work. We asked who had said that they would vote against Johnson on the floor, and the response that lawmakers gave was no one, that everyone was on board. Now, of course, there were about 20 absences, and there were also 3 members who voted present, including Thomas Massey. But Massey came out this morning and said, look, he spoke with Johnson this morning. They had a good conversation, and he's now committed to voting with him on the House floor. And from our understanding, a lot of the absences in the room last night, they were just from members who had other places to be. They're also on board with Mike Johnson. Now, of course, Johnson's going to be a little bit different than what we saw from Kevin McCarthy. He's a lot more conservative than McCarthy is. He is opposed to providing aid in Ukraine. Back in May, he voted against that $40 billion package that most of his Republican colleagues actually supported. He also voted not to certify the 2020 election, and he also voted against the most recent stopgap, although several folks tell me that Johnson has said that he does want to see the bigger long-term appropriation bills done, but he is open to another stopgap to keep the government fully funded. And of course, back in June, he did vote for that final debt limit agreement that kept us from going over the fiscal cliff. And even though Johnson is a little bit more conservative, he's really considered to be well liked by his colleagues. They just see him as a nice guy they can get along with. And we have seen a number of more moderate Republicans who are going to have to win in districts that Biden won in, come out this morning and say that they support him. So things are really looking good for a potential Speaker Mike Johnson. We expect the vote to start around 1 o'clock today. Hope to have a result by 2 and maybe have a speaker by that point as well. Sarah?
You mentioned his support of Ukraine, or lack thereof, and I wonder if there's any discussion now in the next step if he does get the full support, because they're going to have to tackle this $100 billion package, defense package for Israel, Ukraine, and the border.
And certainly there are a lot of Republicans who have said, look, we need to separate out the funding for Israel that needs to move separately from Ukraine. But the fact of the matter is that the House has lost some ground here. You know, the White House came out with their request. The Senate has started to begin working on it. And if the Senate winds up sending a package to the House, that could put pressure on members to vote for potentially Ukraine and Israel funding at the same time. And the fact of the matter is that there are a lot of support for Ukraine funding still, even among Republicans. And if Johnson becomes Speaker, he's going to have to grapple with that.
Yeah, and the fact that defense spending as a percent of GDP, I saw a chart this morning, is the lowest ever. Thank you very much, Emily. Keep us posted from Washington. Just mentioned it, part of the urgency here to select a House Speaker has to do with the aid package for Israel. NBC News correspondent Jay Gray in Tel Aviv, as the UN warns the situation in Gaza is growing more dire by the day, by the hour. Jay, what can you tell us?
Yeah, Sarah, no, you're absolutely right. It appears that a lot of the humanitarian effort inside of Gaza is beginning to crumble at this point. The UN agency, UNRWA, which provides assistance and help inside of Gaza and has for decades, saying that they're going to be forced to stop helping there only because they're out of resources and primarily out of fuel. 600,000 people displaced in Gaza, families who are staying in 150 of their facilities, are not going to get some of the assistance they've been getting, some of the food, some of the electricity and warmth. It's going to end because they don't have any fuel, and there's no sign that any fuel is on the way. We know that more aid trucks rolled into Gaza today across the Egyptian border, but Israeli teams continue to inspect those trucks, and they have been adamant that as this war continues, there will be absolutely no fuel moving into Gaza for fears that Hamas will take that fuel and use it to fire rockets and use it in the war against Israel. And to that point, today, the IDF revealed some photos online that they say shows fuel tanks within Hamas compounds there, and said, as a part of their post, here is some fuel, get it from Hamas. And so they're saying that there is fuel inside Gaza, that Hamas has control of it, and they're not sharing it. They're not helping the hospitals that so desperately need this. Talk to a doctor who is in contact with some of those inside Gaza, and he says that the situation is growing much more dire by the hour, not only because of the fuel, but because there's just no room left, that they don't have any more space in any of the hospitals, that they are treating people in the hallways, on the floors. And so that's something that continues to push what is a growing chorus for a brief pause in the airstrikes from Israel, a humanitarian pause. The UN pushed a resolution on that yesterday. It did not pass, obviously, and the strikes have continued over the last 24 hours. Let's touch briefly on the hostages. We know that there are more than 200 still inside Gaza, and we know that the back-channel negotiations are going. In fact, officials in Qatar say they've actually intensified over the last couple of days, and they have some hope that they will be able to break through and broker a deal that will allow a number of hostages to be released. There's a lot of back and forth about whether Israel will begin a ground assault before a substantial number of the hostages have been released. Israel continues to say they're going to do that on their terms and on their time, Sarah.
Jay, any sense of what happens to the aid? There's a lot made of how many trucks are going in and how fast we can get them, and everyone wants the aid trucks going in. Do they end up in the right places?
Yeah, we've seen some video of the Red Crescent delivering some of that aid, and it does. But remember this, what's going in right now is about 4% of what, during a normal day with no war, normally flows into Gaza every day. So we're seeing at the most 20 trucks go in. They say that 400 to 500 semi-trucks move through Gaza every day with supplies. So it's getting to people who need it. There are just a lot more people that need that aid than they actually have supplies for.
Jay, the Journal right now reporting that Israel has agreed to delay any ground invasion until the U.S. can get some missile defenses in place, maybe later this week. We'll find out more later. Jay Gray in Tel Aviv. After the break, Snap returning to growth. We'll talk about what went wrong at Alphabet, plus a look ahead to Meta tonight with the S&P communications sector down 4%, near a one-month low.
Then CME Group's Terry Duffy joins us. His outlook on rates and commodities as CME delivers its 9th consecutive quarter of double-digit earnings growth. Stay with us.
CNBC. Live ambitiously.
Telenor shares are higher in Oslo this morning after the telecoms operator topped third quarter profit expectations with net profit of 2.5 billion Norwegian kroner.
We had a 4% revenue growth in our portfolio. We had a 7% EBITDA growth. And as you said, we surprised the market on the cash flow. I'm especially happy with the sustaining growth we have in the Nordics. This is the fourth quarter in a row. We are growing our mobile revenue 5%.
Good morning. Let's get straight to markets.
This is how we're setting up the trade.
Factual. Succinct. All you need to know before your trading day starts. Subscribe to our newsletter, CNBC's Daily Open.
Commit to energy. Focus on innovation. Discover the next growth opportunities. Climate technology. All you need to know to invest in the future. The ultimate source. CNBC.com/climate.
bearish sentiment from a pair of housing CEOs this morning. There's Taylor Morrison CEO Sheryl Palmer warning on the earnings call that, quote, the rapid reacceleration in interest rates in September has once again injected some hesitation into the housing market. While the CEO of CoStar parent Apartments.com and Homes.com says, quote, the current environment is one of the worst housing markets in decades. All of that said, we did get decent news on new home sales data in the last hour. That was a 12% beat. Even Torsten Slok of Apollo thought, whoa, that's surprising given the 8% mortgage rate.
Indeed. Meantime,
discounting helps.
Meantime, the sun has stopped shining on shares of Alphabet today as Cloud severely disappoints. Stocks down double digits, worst earnings print since 2020. Revenue miss, slowing growth in that division, not helped by the results across the street of Microsoft either, which did have significant growth in its cloud business, Azure. Joining us on the two tech titans going opposite ways, Guggenheim's Senior Managing Director Michael Morris and CNBC Senior Media and Tech Correspondent Julia Boorstin. Guys, great to see you both. Thanks for the help on this. Julia, let me turn to you and ask whether or not B of A's right when they said it was a bad night to miss on cloud.
But that was the thing, is that they missed on cloud, but they beat on advertising. So if you want to contextualize Google as this business or Alphabet that has so many different pieces to it, the cloud business did underperform expectations, but the advertising business outperformed. And I think if you want to look ahead to Meta, which is after the bell today, it bodes well for what we could see for Meta. They saw accelerating growth at YouTube in search, and that does bode well for Meta. I think the fact that cloud disappointed was a real surprise, especially given how it's now going in a very different direction than Microsoft.
Yeah, especially, Michael, that a lot of people have been hiding out in Alphabet going into the print.
Well, I think that's correct, and I agree with a couple things that Julie just pointed out, right? So first of all, the core business at Alphabet continues to be healthy, and that is the advertising business, the search business, the YouTube business. But there are a couple of concerns on the name that came up following the report last night. One on cloud, where the company underperformed. Also on AI, where it feels like it's a very, very competitive environment with the other large tech players. And every time somebody gets closer to a new practical application, the other players in the space seem to take some heat. There's also a little bit of concern about expense growth at the company. The company has been pretty clear that they think they can fuel their growthy ambitions by managing costs in other parts of the business, but margins were a little softer in the quarter. They talked about some CapEx in the fourth quarter, and I think that concerned investors as well.
Does it deserve to be punished 9% down today, and you stick with the $150 price target?
No, it doesn't deserve to be punished 9% down. I mean, the market is humbling and we respect it, but I think this will ultimately prove to be a buying opportunity. I think that we're in the top of the first inning for what AI ultimately is for this industry. And the leaders, when they're able to lean into the businesses when they are at their strongest, in Google's case, it's advertising, it's search. I think that their tools will be powerful. They will be money-making. AI is going to be a multi-trillion-dollar opportunity for the industry at large, and Google's going to be there. Alphabet will be there. We want to be long this stock, but we respect the move today and see it ultimately as a buying opportunity.
Meantime, almost classic volatility in Snap last night, right?
I mean, that stock shot higher on the fact that there was a surprise, not only beat on the top and bottom line, but instead of reporting a loss in earnings per share, there was actually a gain in earnings per share. And then also the fact that revenue accelerated. Snap's revenue grew 2% instead of declining 5%, which is what analysts expected. So that really indicating that the changes they've made to their ad platform are working, but they're also seeing strength in direct response advertising. This is something, again, to reference Meta earnings after the bell, that Meta is really focused on, and direct response is expected to be able to be a little bit more resilient if there is a pullback in advertising. Now, the interesting thing here is that Snap did indicate, as did YouTube and search, that the ad market is stronger than many had feared. The question is whether there's going to be volatility ahead, and Snap CEO Evan Spiegel warned that they did see a pullback in brand advertising once the war started between Hamas and Israel, and they're concerned that if this war continues, as many people say it will, then it will have a big impact on brand advertising in the all-important fourth quarter. So that is where the uncertainty lies, and that really did put pressure on the stock.
Michael, how do you process all of that?
Well, I think, again, Julia hit a lot of the key points here. I think that when you see the move in the stock, especially the surprise pop last night, it's a matter of a stronger performance against low expectations. Snap has clearly been out of favor with investors for quite some time, and seeing a surprise top-line beat is always going to drive the stock higher in the short term. I do think it is good for the company to see that advertising growth, but the things to keep in mind is that growth is still modest. It's on easier comparisons. The company is not generating engagement and impressions on its monetizable surfaces, things like video, anywhere close to the rate of its peers. It grew its impressions by about 7%. Peers are growing by 30% plus. So while we think it's a step in the right direction for Snap, it's still a very modest step compared to peers. That's why we remain on the sidelines.
So if you add up Snap and Alphabet, and Julia hit on this a bit with Meta, we're looking forward to Meta reporting after the bell, a stock that's up more than 150% year to date, but is weaker today on the back of Alphabet sell-off. What does it mean, Michael?
Sure. Well, I mean, there's a couple of considerations always. One, and when we see some underperformance of one of the larger players, it does tend to flow through to a couple of the other names, especially when they have been in favor, to your point about the appreciation in the shares as much as they have. There also was the news yesterday about a lawsuit being brought by multiple state AGs that does bring up questions about some of the challenges that the business can have in the future. Now, we think that the company is strong enough that they're going to overcome those challenges. When we think about reading through performance that we learned about last night compared to what we see from Meta, we think Meta is absolutely a stronger player. Our advertising checks indicate that spend on Meta accelerated in the quarter, so we feel very good about what they should be able to report compared to peers, but it has been an outstanding performer. There's always risk that some people take a little bit off going into the print, and I think that's what you're seeing right now.
I mean, expectations are high going into these earnings. The stock is up so much in the past 12 months. And the real question here, I think, on the heels of yesterday's news about these attorneys general suing Meta is, could that potentially impact the business? Could that curtail the way they are targeting teens with ads? Could that curtail a big piece of their business? Or, as Meta says, is this something they're really working on top of? So I hope Mark Zuckerberg addresses that in the call today.
Or is it just going to be some civil fines, right?
Or some fines.
Yeah.
But will the fines be meaningful? We'll see.
Great discussion on that point on Squawk this morning. What a good week to have you in-house, Julia. Julia Boorstin and Michael, thanks so much.
Up next, Porsche's warning about the luxury consumer. The stock getting hit hard this morning.
Plus, watch Boeing. What a swing, providing no relief to the Dow now, maintaining free cash flow estimates, but they did cut the MAX delivery forecast, something we talked to Dave Calhoun about earlier this morning.
We know the work that has to get done. We put it into the scope of our factories, and I think it'll be a little better than probably many had surmised. And we'll get back to our full rate by the time we get to the end of the year.
Opportunity is using data to create a competitive advantage.
It's raising capital to help companies change the world.
Opportunity is making the dream of home ownership a reality.
And driving the world forward to a greener energy future.
Sometimes the only thing standing between you and opportunity is someone who can make the connection.
At ICE, we connect people to opportunity.
CNBC. Live ambitiously.
It's one of the most fossil fuel reliant economies in the world.
South Korea has been continuously increasing the share of renewable energy, striking a balance between nuclear and renewable energy while reducing the number of thermal power plants. Eventually, it boils down to how to achieve carbon neutrality. It's something the global community needs to work on to avoid a catastrophic result.
Will South Korea's plans to go green work? We find out on the next Sustainable Future.
Shares of Lifetime getting hit hard this morning. Our Brandon Gomez has a market flash on the fitness group's downturn today. Hi, Brandon.
Hey, Carl. Yeah, that's right. Lifetime shares down double digits after a brief pop this morning. I just got off the call. The executive team bullish on their strategy to execute on expansion with new locations, relying on premium member experience for their more affluent consumer base to limit any kind of elasticity risk. But the street clearly down on the stock, revenue and EPS falling short this quarter. The company saying revenue was a miss, in part due to a delayed club opening and sale of some non-profitable assets, issuing weaker than expected revenue guidance for Q4 as well, weighing on shares. Lifetime putting a pause on sale leaseback transactions as they continue to monitor rates, which we obviously follow here at CNBC. Carl, all of that weighing on shares, down 30% over the last 3 months. Carl, back to you.
Brandon, thanks for that. Brandon Gomez. Let's get a news update this morning as well with Leslie Pickard. Hi again, Leslie.
Hi, Carl. Israel has reportedly agreed to delay its invasion of Gaza so that the Pentagon can get its air defenses in place to protect U.S. troops in the region. That's according to the Wall Street Journal, which reports the Defense Department is scrambling to deploy the assets because of the likelihood U.S. troops would be targeted around the region when Israel moves in. The House of Representatives will convene in just minutes and could hold a vote on the new Republican nominee for Speaker. Representative Mike Johnson of Louisiana is the fourth congressman to be nominated for the job, which has been vacant for 3 weeks now since the ousting of Kevin McCarthy. Johnson has received backing from former President Donald Trump and McCarthy. And Hurricane Otis made landfall as a major Category 5 hurricane in Acapulco, Mexico overnight and knocked out all communications in the region. It's the strongest hurricane to ever hit the country and the eastern Pacific. The storm rapidly strengthened in a matter of hours, catching some forecasters by surprise. Back over to you, Sarah.
All right, Leslie, thank you. European markets turning higher as we head into the close, with the FTSE notching the biggest gains in the UK. Mining and tech are the outperformers right now, while retail and leisure are lagging. Among retail names moving, Gucci and Balenciaga owner Kering Group hitting its lowest level since March 2020. And then on the positive side, Deutsche Bank helping turn around the banking sector over there after beating third quarter expectations despite ongoing struggles with its investing arm. Right now, though, all eyes are on the European Central Bank. ECB expected to hold rates steady when it meets this week after we saw a 90 basis point decline after we saw a rate hike in September, I should say. President Christine Lagarde set to speak this afternoon. Carl, and the feeling is that the economy has turned south in Europe, and the ECB, like the Fed, has done a lot of hiking rates. They've seen progress on inflation. It's not back to target, so there is some mystery and drama surrounding what she says about the need to potentially raise more and keep it for how high for how long.
Yeah, at least German IFO went higher a little bit, and Bank of Canada held. We didn't mention that.
Bank of Canada held, as expected, but there have been some surprises lately. So central banks are in the pause mode.
Yeah, big week.
Are they done?
Week.
We don't know.
Exactly. Meantime, Kering is the only luxury name down today. Porsche, one of the big laggards out of Europe today, down after the CEO warned about the future of the luxury consumer. That piqued the interest of our Robert Frank today. Hey, Robert.
Good morning, Carl. Well, Porsche's CFO this morning adding to fears that the luxury consumer may be breaking down a bit. He said, quote, "We are suffering in the entire economy. It's also hitting the luxury industry." Those shares down 12% this year, down about 6% today. And LVMH earlier this month reporting sales growth of 9%. Doesn't sound bad, but that was half the level of earlier quarters. LVMH stock down now 24% from its highs. The company's CFO saying, quote, "After 3 roaring years, growth is converging more in line with the historical average." And then luxury giant Kering taking the biggest hit. The owner of Gucci and Saint Laurent saw North American sales down 21%. Then Asia ex-Japan was flat as China recovery also slows. Kering's stock down 35% from its highs, now at its lowest level since March of 2020. Even Hermes, which beat on sales and is always the strongest of those luxury players, has seen its stock down 12%. Analysts say the most discretionary items from aspirational brands are most at risk right now. And guys, the surest sign that the roaring 20s may be ending for luxury, even champagne sales are down for the first time in 3 years. Sarah?
Does this mean, at least, Robert, that there'll be some relief on pricing? Because with these luxury handbags and shoes, it was like there was no ceiling.
You're right. I mean, you look at the Chanel flat bag, that now is $10,000 or more. That's twice what it was pre-pandemic. And as you've been pointing out for a while, it's that those price increases that were so dramatic for some products that may have just hit the ceiling, but a lot of it is just most of the buyers of luxury goods are not wealthy. They're upper middle class people that like to splurge. And again, when they're not having all that extra cash like they don't right now, that's going to hurt those discretionary purchases most.
All right, waiting for the pricing to come down, I guess, then. Robert, thank you. Robert Frank. Shares of CME Group making a comeback this morning after the company did report an earnings beat. CME Chair and CEO Terry Duffy joins us next for more on the quarter and his outlook for all this volatility in the rates market. We'll be right back.
CNBC. Live ambitiously.
And we always try to diversify our risk. This is not leaving a country or leaving a specific region, but we diversify, of course, our risk. We need to do that anyway because, especially Neue Klasse, it will not be a small volume. So we need, from the large suppliers, we need more than one anyway, but we are neither leaving China nor do we leave another region.
Partially filled. Order 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 filled. Order partially 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 filled. Order filled. Order partially filled. Order filled.
Welcome back. Turning now to the CME Group, an earnings mover today, seeing its 9th consecutive quarter of double-digit earnings growth as investors continue to turn to that derivatives business to mitigate risk amid all the volatility. The stock is now up more than 25% on the year. Joining us now in an exclusive interview is CME Group Chairman and CEO Terry Duffy. Welcome back, Terry. Good to have you.
Thanks, Sarah. Appreciate it.
Clearly, it's been volatile in the rates market, more so than even stocks. How's that affecting you?
Well, I mean, obviously to a very positive effect for us. I mean, there's so much stuff going on in the rates market today. Sarah, as you all know, you discuss it constantly. But, you know, if you could take this back even just a few months and see where a lot of this stuff started, especially with duration risk, I think there's been so much of an opinion that, you know, I heard Carl talking before the break, you know, central banks are potentially pausing. but the rates market continues to move. So, you know, duration risk is a concern, so no matter how small or how big you are, and people need to mitigate and manage that risk. And for CME, we're seeing the benefits of that, and that's exactly what they should be doing. Also, with the issuance, Sarah, you know, there's going to be a large issuance continuing to come out, and the traditional buyer of that has been the Fed, and the Fed's not buying, as we know. So if the Fed's not buying, the Fed doesn't hedge, that means other people are buying, and they do need to hedge, going back to what I just said about duration risk. So if you're buying government treasuries today and you're not going to hedge them, and you're not the Federal Reserve, that could be a very risky proposal.
So do you chalk this move in rates up to the concerns about supply and demand of Treasury issuance?
Well, I think it's important to talk about the supply and demand of treasuries, because you're starting to see other asset classes catch a bid. Like you see Bitcoin right now, you know, just below 35,000. I'm not saying people are leaving treasuries and going to crypto, but there appears to be more than just an ETF announcement from BlackRock and DTCC. It's got to be some people diversifying. You got gold just under $2,000 an ounce. You had oil come up, but it sold off. I think people are diversifying away from some treasuries, and that's part of the equation. So yes, that has a massive effect on the supply.
Terry, I know there's been some on the street that are calling for you to find ways to generate revenue if and when rate volatility backs off. I mean, do you see that day coming? And if it does, what then?
You know, Carl, I'm not going to speculate on that. Right now, when you look at our business, 80% of our revenue is derived from transactions. You know, we've been sitting here for the last several years talking about rate markets. We have a rate market right now. We have the most uncertain world that we've ever seen on the planet. We're here to mitigate and manage risk. We are in a strong sweet spot. As far as looking at other reoccurring revenues, I think what you're referring to is a recent article about would we do something from an M&A perspective to get reoccurring revenue. We have reoccurring revenue, Carl. It's called trading. And right now, that doesn't seem to be going away for the foreseeable future. So I think we're in a really sweet spot. And when you have operating margins of 70% associated with that transactional revenue, that's a pretty good business that a lot of people like to be in.
So you don't have to go buy the CBOE, which I think is really what the article's about from Reuters.
Well, that's what it's about, but as the article suggests, and the headlines are deceiving, Sarah, and unfortunately people only read headlines in the world that we live in today, but if you read the body of the article, I said what I've been saying for years, that we are in the strongest position of any institution that looks like us to do M&A deals, and there's going to be a lot of people shopping those deals towards us, and it doesn't mean we're going to acquire them. I will never do anything that does not benefit the users of my marketplace or my shareholders. So I'm not going to look to do deals just to do deals. I was only referencing that our EBITDA is less than 1 times where our other competitors, if you want to call them that, they're multiples higher than that. So that was all it was, and I think sometimes the headlines are deceiving.
How about the energy and commodities business? I mean, it's been a little wild lately. I wonder how long you think that could last.
You know, Carl, it's hard to predict, but right now I wouldn't want to put a timeline on it. You know, we've all kind of forgotten about what's going on in Ukraine and Russia, which has a huge impact on the energy prices because our focus is on Israel right now, and maybe rightfully so, obviously. So there's so much uncertainty around the world. You know, the energy sources, we're already looking to import, you know, oil from, you know, places that we never thought we'd go back to ever again, and we're back there. So hopefully that we can get more drilling going on here in the United States, become sufficient, but at the same time have a long-term plan how we make sure we keep the planet safe. But again, I think that energy business is strong. It's up significantly year over year, and I don't see that backing off right now in lieu of what's going on geopolitically.
I remember when after Silicon Valley Bank failed, you came on and you were just railing against the management for not appropriately hedging their interest rate risk. Has that improved? Because this is still sort of this lingering issue for regional banks in particular.
Yeah, and as I said at the beginning, Sarah, I don't think it's just the regionals. I mean, everybody's got some kind of duration risk on their books. So no matter how big or small you are, you need to manage that because you never know what's going to happen. Just because the Fed has paused and other central banks have paused, it doesn't mean they're not going to have to accelerate again for whatever reason it may be. So whether the auctions are bad, we still need to pay bills, and the way we pay bills is to issue debt in the same way other countries around the world do it. So again, if there's not a demand for that, I think that you got to be careful where rates are going. So I think people need to manage that duration risk no matter what the size of your companies are, and I think that's what's going on right now.
And then one final one for me is just, are Treasury safe havens anymore? You mentioned the move we've seen in gold and in Bitcoin, the interest there. dollar, kind of mixed. But what do you tell people when they ask about the volatile world and the geopolitical landscape and wonder if they should be buying those risk-free bonds?
This will be a Terry Duffy opinion, not a CME opinion. Of course, I own them. I still believe that they're a very safe haven because you look around the world, what else are you going to buy? Where else are you going to put your money in today's world? It's very difficult. The world is a dangerous place. The United States of America is still the best place in the world to keep money. It's been that way for years and years. I don't see that changing. My only earlier point was diversification is not a bad thing, and we might be starting to see that. It's happened in the past, whether it's with stocks when we had a zero interest rate environment, or now we're seeing it with rates going up. So I don't see people going away from the largest market in the world, which is the U.S. Treasury market. So we might have back and forth, but it's not going away.
All right. That's what we wanted, the Terry Duffy opinion. Thank you very much. Always appreciate you joining us.
Thanks, Sarah. Thanks, Carl.
Chairman,
Thanks,
CEO, Sammy.
Coming up after the break, California suspending Cruise's autonomous driving permit. What a halt of its robot taxi service might mean for GM and Google's Waymo. Stay with us.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
CNBC. Live ambitiously.
I think there's something for the Bulls and the Bears in this one as well. Posted an 8% drop in third quarter profits. Some analysts say not as steep as expected. Revenue, though, falling at the investment bank, despite the corporate and retail divisions looking pretty solid.
What's going on is the normalization of fixed income and currencies revenues that we called for, especially in the macro businesses, so rates, foreign exchange, and emerging markets, where they had benefited last year from the very high levels of volatility.
If it's just this 1 trillion RMB bond, it's not going to be enough. China is a huge economy. 1 trillion helps on the margin, but it doesn't really solve all the problems. But what it signals is the government is taking a step on the fiscal front, and most likely next year they will run a bigger fiscal deficit. The overall fiscal policy strategy has changed.
General Motors robo-taxi service Cruise now no longer allowed to operate in California after the state's DMV suspended its permits. Deirdre Bose has been following that story for today's Tech Check. What a story, Dee.
What a story indeed, and more details are emerging. The question being asked today by the DMV and public officials is this: was there a cover-up? The incident under investigation involves a driverless Cruise vehicle that initially came to a hard stop running over a pedestrian. From there, it gets fuzzy. The DMV alleges that Cruise only showed footage up to that stop and left out subsequent footage of the vehicle pulling over a distance of about 20 feet while dragging the pedestrian under the car the entire time. We're going to show you an image of the fire department physically lifting the car off of the woman. Now, Cruise disputes this and says that it shared the full video, but the investigation has much broader implications for the entire autonomous driving industry. Here's what part of that landscape looks like. It involves some of the biggest names in tech that have been shelling out billions of dollars in those ambitions. Cruise, of course, is backed by General Motors. Its main robotaxi competitor is Waymo, which is owned by Alphabet. Others in the space include Amazon, which bought Zoox for $1.2 billion in 2020, Apple's rumored Project Titan that we know very little about, and Tesla's own, though very early, plans for a full robotaxi fleet. Now, Waymo and Cruise have been taking paid rides since August, so they are arguably closer to rolling out for the mainstream. Waymo already has the edge. Cruise's suspension now likely to widen that gap further. For all of them, though, the costs are high, the regulatory hurdles are many, but the payoff promise is huge. GM has said that Cruise could generate up to $50 billion in revenue each year starting in 2030. Elon Musk has used his robotaxi push to justify Tesla's valuation. Last point I want to make here, the backlash, you're hearing it now, but it had been building well ahead of this latest Cruise incident, and it could bolster the argument for other cities around America to slow or even resist testing altogether. And that would hit not just the end players who we showed you, but the companies that are supplying the chips, the LiDAR sensors, and other technology to them. A few of those names up on your screen now, like NVIDIA, Mobileye, and Qualcomm.
All right, we'll be watching them. Thank you, Deirdre Bosa. Up next, what can the Fed do about the deficit? Why the answer differs from the past. Stay with us.
CNBC. Live ambitiously.
Markets have been reacting to fears of higher interest rates.
The stories and opportunities driving Wall Street and investors.
Oil finally closing higher.
Tyler Matheson, Kelly Evans. Power Lunch on CNBC.
Nita Mukesh Ambani, the founder of Reliance Foundation, speaks about her new cultural center.
It's taken us now a decade to bring this to life, to show the best of India to the world and get the best of the world to India.
On the Reliance Foundation,
a nation's development depends on women empowerment and the well-being of its children.
On family,
I am so blessed to have Mukesh, who is my best friend and my life partner.
Nita Mukesh Ambani sits down for the CNBC conversation.
U.S. budget deficit showing no signs of slowing down, growing to $1.7 trillion in 23 from $1.4 in 22. Intense borrowing doesn't help the Fed chair's mission to stem inflation, but our next guest doesn't think there's much he can do to stop it. He writes this morning that despite Powell chiming in on fiscal policy during the pandemic, commentary now may just make unwanted enemies. Joining us this morning, Wall Street Journal's chief economics commentator, Greg Epp. It's a great snapshot, Greg, at how his stance and rhetoric surrounding this has changed over time.
Yeah, I mean, there's kind of an asymmetry there, Carl, right? I mean, like in the 2020, we had the pandemic, and yes, the economy was in a very dire strait. And Powell was quite vocal, saying, yeah, we need more stimulus. We need to help people out. And I get where that's coming from. The economy was in a bad shape, and the Fed had done all it could do. It had lowered rates to zero, so fiscal policy was the only game in town. But you could sort of argue, well, wouldn't symmetry require that once the deficit is becoming a threat in the other direction, that you say something? And apparently the answer is no. When Powell is asked about it, he says, we don't comment on fiscal policy. And is that the right thing? I know there are people like Larry Summers, like Paul Ryan, the former speaker, who would like him to speak out, but he has apparently concluded that there's probably no upside to him doing that.
What is the downside?
Well, I think he has tried since he became chairman to basically sort of like, I think his words are stay in our lane, essentially not comment on things that have nothing to do with monetary policy. And look, as you know, we're in a very polarized time, and the risk is that if you take a position on controversial subjects, it comes back to bite you. You give cheer to those who agree with you, but you make enemies of those who disagree with you. And, you know, the truth is, like back in the early 1990s, George H.W. Bush, Bill Clinton, these were presidents who were ready to listen to advice and make some hard decisions. Congress wasn't as polarized as it is now. Those aren't the times we live in now. I like to say that Congress uses the Fed chairman the way a drunk uses a lamppost, support rather than illumination.
Yeah. I mean, the other risk, Greg, is, first of all, it is politicized, right? There are certain members, for instance, of the Republican Party that have taken a harder line against deficit spending than Democrats, and he doesn't want to get embroiled or lumped in with one of those sides. And the other is it's not clear whether it's having an effect on the economy. I think back when he spoke out about the need for fiscal spending, it was more to juice the economy. In this case, it might be having an impact on bond market and eventually may slow growth, but right now it's not clear that that's what's happening.
Absolutely. It's not like the deficit is a clear and present danger where the explanation and the solution are both fairly obvious. This is in Greece, right, where we're about to face total bankruptcy and economic cataclysm. And, you know, it's necessary for people like a central banker to speak out. There are a variety of, you know, theories about why bond yields are going up. I happen to think the deficit's one of the reasons. A lot of people disagree. And then there's the sort of the counterintuitive reality that as far as the Fed is concerned, because most of this rise in bond yields is in the form of the term premium, as opposed to investors thinking the Fed's going to tighten more, that higher term premium actually slows economic growth and makes the Fed less likely to raise interest rates. So you don't exactly want to go to Washington and say, oh, that deficit that I'm really worried about, it means we're less likely to raise interest rates. That's not a message you want to be telling Congress right now.
And it also helps him, because that's what he's trying to do, is slow the economy enough to get inflation back to target, which has not fully happened yet.
Yeah, but on the other hand, you know, what would really help them now would be a little bit of contractionary fiscal policy. I mean, it is the mirror image of the period we had, you know, after the global financial crisis and during the pandemic, when monetary policy was doing all it could do, interest rates were at zero, the Fed was buying bonds, and it still wasn't enough to help the economy. That's when there was a role for fiscal policy. We're not in that world any longer. The Fed is doing all it can to get inflation down, which is too high, and a little bit of help from the fiscal authorities, higher taxes, lower spending would actually, you know, give the Fed a valuable assist here and perhaps make higher interest rates less necessary.
Greg, one thing he's said in the last few days is that the good news we've gotten on disinflation lately is just the beginning of what will be eventually necessary. I wonder, are you hearing that the 3-month annualized data we've gotten lately is durable?
You know, we're going to get an important number out this week. It'll be the PCE inflation number. I think people are looking for that number to be constructive, but I think it's probably going to have a slightly firmer reading than we had from the CPI inflation number a few weeks ago. I think that if you sort of like canvass the expert opinion, There's a view that we've probably brought underlying inflation down to around the 3% area, but there's a lot of, but we still have that last mile problem ahead of us. My own gut instinct is that we're going to have the Fed on pause at their next meeting, but they will keep the door open to having to do more because they themselves are not certain that they've solved that last mile problem.
The last mile problem. Yeah, same thing in e-commerce as in monetary policy, Greg.
That's right.
Great piece as always. Great to check in with you. Thanks, Greg.
Great. Thanks for having me.
Of the Wall Street Journal. So we kind of been all over the map, but for the most part, holding 4,200 S&P has been the important key today.
We've also got strength in a spot other than defensives because consumer staples and utilities are up, but financials are also rising today, and that, you know, obviously has been a question mark as far as a source of strength for the market after better earnings. We're going to get more coming after the bell and as far as barometers. Meta, IBM will be reporting, UPS, Honeywell, Comcast all out tomorrow. So busiest week of earnings continues and the pressure on the market continues and the 10-year yield is above 4.9 again. It's not 5, but it is rising. So we watch it.
Yeah, I mean, we started the morning around 486, 487. New home sales came in strong. And again, upside pressure, and that's done the kind of damage that we'll get. We're all pulled tonight as well. Some of the hallmark names that Santoli's been pointing out,
and we'll
very
get
sensitive to risk.
Q3 GDP tomorrow, which I think is going to be key because everyone's expecting a strong number. How strong is it, and does that set up for stronger growth in the fourth quarter and into next year?
Goldman, which started at 1.5 and slowly worked their way up to 4.6, just increases it one more tenth to 4.7. After the new home sales data. So big day
Everybody's been revising straight up, joining the Atlanta Fed GDP, which is at what, above 5%?
5.4 in Atlanta. Let's get to the judge who's in Philly today for the half.
Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner, live today from the Schwab Impact Conference right here in Philadelphia. Thousands of registered investment advisors are here, including our very own Jason Snipe. He's going to be with us in just a few minutes. He's on the stage now, but he's going to make his way over to our platform when he is off. The rest of the investment committee debating the markets today as well. The mega caps, of course, Microsoft and Alphabet as they trade in opposite directions today. And the stage now set for Meta this afternoon. There is lots to discuss for all of you. With me for the hour today, Stephanie Link, Joe Terranova, Jenny Harrington is with us, and Katie Stockton of Fairlead Strategies is here at Impact as well. It's nice to see you. Thank you for joining us. So let's check the markets. By now, you know the story. The NASDAQ is where the bulk of the damage is today. Look at that. Down near 2%. It's a loss of 236 points. Yields are very much a story today as well. Backing up yet again towards 5%. There's 491, the 10-year note yield. However, Joe, I do want to start with Microsoft. That is the story today, or certainly one of the stories, at least the positive story today. Azure cloud revenue growth accelerating for the first time in a couple of years because of AI. You own the stock. Give me your take.
Well, it's good that we saw our cloud services growth back above 28%, which was the expectation that I had on Monday. That's where it needed to be. But overall, the impact of what we expected from Microsoft on the market itself, its ability to stabilize the market, it obviously is not present. And Scott, the reason it's not present is these stocks are called the Magnificent Seven. Now we're down to the Magnificent Five. We've lost Tesla, we've lost Alphabet. We'll get into the reasons why we lost Alphabet in a few seconds, but just overall, for the ability of Microsoft to stabilize the market, and obviously the reason that it's not, you needed all of the Magnificent Seven to push up against a lot of very troubling signals within the market itself. I think we've done, at least myself, I've looked towards this Magnificent Seven and I've looked away from the troubles. But what's going on this month in real estate? What's going on this month with the banks? What's going on with the financials, the response, the reaction to earnings? And let's remember something. The reaction to what is very good earnings so far has been horrific. We're seeing the revenue growth at 4%. We're seeing the earnings growth at 7%, but stocks are not reacting accordingly. And that's why we're in a very uncomfortable place right now. 4,200, the technical level's holding us up, but the rise in yields, we're pushing up down against that, and we're below the 200-day moving average. Look like we're going to close below it for the second time in the last few days.
Yeah, Joe makes a lot of good points, Jenny. So give us your view We're barely above 4,200. We're, teetering a little bit there. The tech trade, I don't know if it looks tired to you, but these stocks have done so well that these earnings reports we're going to have to be knock it out of the park, so to speak, to keep up the momentum, and it just doesn't look like that's going to be the case.
Yeah, so I don't think it's just tired, Scott. I think it's thoroughly exhausted. And it's really interesting when I take Google and Microsoft versus my portfolio yesterday. So you've got, Alphabet, where they had amazing numbers, right? Like they beat by $1 billion on revenues, earnings came in 10 cents ahead, stocks down 9%. Microsoft,